Hello, my voice is audible, ma? Hello, my voice is audible?
Yes, sir.
Yes, sir. Thank you. Thank you. Good morning, everyone. Notes is visible? Hello, notes is visible, ma? Tell me yes or no, ma? Sudhir, notes is visible or not?
Yeah, yes, sir. It's visible, sir. Visible.
Okay, thank you. Thank you. Today we're going to discuss about the Indian banking and financial systems. Banking and the Indian financial systems. Banking means you people know about banking. What are the main operations of banking? Bank is the backbone of our economy. Money circulation is the backbone of the economy because money circulation is stopped in any country. It's like a blood of the economy. Inflow outflow is very very important. That inflow outflow part will be take care of all the transaction detail, foreign transaction, domestic transaction, national transaction, all the transaction done through bank. Bank is a legal entity between the customer and the depositors or lender and the depositors. Bank play a vital role for our economy. Agriculture is the backbone of our economy. Same wise, banking role also backbone of economy. Present days, our economy is still stable economy. We didn't go for higher inflation. We didn't go for lower inflation. Our GDP also maintain stability in nature because of banking operations that much strong in nature and our banking systems. So this semester we going to discuss about banking and the financial system and its operations and its services. All this function we go to study about the semesters because only 6 hours I can complete the entire 5 units. So I need your support and also passionately you can discuss your question regarding whatever doubt arise in your mind. You can ask anytime. The floor is always open. So we move on to the topics. Banking system and its functions. First one, the structure of Indian banking system. You can expect this question from 10 marks. Structure of Indian banking systems. Then followed by bankers and customer relationship. You can expect this question for 5 marks. Just you are appearing for 75 marks. Sir. Okay, 4 marks I think. And deposit loans and advances you can expect 8 marks and 10 marks. That I don't know whether new. Then check, crossing, endorsement, development, collection of payment. So you can give important to structure of banking Indian systems. That question you can expect from your 10 marks question. Banking system and functions, banker and customer relationship. You can expect the question from the exam point of exam. You can expect the question from your exams. And banker and customer relationships. Now move on to the subject. So what is meant by banking? So many people know what is meant by banking. Banking is the accepting a deposit for the purpose of lending the money. So bank will generate the revenue from accepting the deposit for the lending purpose. Because bank is a legal entity to provide service to the depositor as well as lender. That is called as banking. So term as bank derived from the French banco, which means money exchange table. That's why I told you very clearly. Money exchange between the depositor and the lender. Lender means who depositor means deposit the money. They can expect interest rate from the banks after 5 years period of time or 1 year period of time or 10 years period of time, long time, medium time, and short term period. They can expect they invest money in the banking. They act like a sleeping partner. They invest or deposit the money in the bank, then they expect interest rate for 7% or 8% for short term period or long term period or a medium term period. The term deposit, recurring deposit, fixed deposits. Many deposits, terms of deposits available in banking. They can deposit money in any product, a term deposit or fixed deposit or recurring deposit. So the deposit bank accepting the deposit from the depositor, they can keep it, they keep it at not hold, because if you keep it at hold means what will happen? The money doesn't have value. That's very, very important. The money doesn't have value. So you can find people, you can analyze the people who are repaying the loan to the bank within the period. That's very, very period, 10-year period or 18 years period or 1 year period or 1 month period. Repaying capability is very, very important. Repaying capability. Without repaying capability, the money come under NPA, non-performing assets. So bank will be identifying the people who are need money, because one is excess of money, other side need of money, fulfilling the both requirement, the job done by banks. One side is excess of money, other side is need of money. So need of money is people borrowing money from the bank. Excess of money means people will deposit money in the bank. This is the main process in anywhere of this global. The banking operation done through this process. This is a common model, this is a common process. Accepting the deposit for the lending purpose. What the other side is excess of money and other side need of money. Fulfilling both people requirements. Both people requirements fulfilled by the bank. They are not bank, because money circulation is very, very important. Flow of money, inflow and outflow. How blood is very, very important for our circulation. My human being want to be survival for blood circulation is very, very important. Economy want to survive, money circulation is very, very important. That's money circulation, inflow, outflow, very, very important. That will be a stability in nature, that will be equilibrium nature. That nature will be constantly monitored and everything done by banks. That is called as banks. This is the definition of banks. Then banking systems. Banking systems, you know very, very well. Banking systems. In India, banking systems is different banks are available, like commercial banks, private banks, public banks, and followed by foreign banks, and cooperative bank, regional rural banks, cooperative bank, regional rural banks, and Mahela banks for women purpose. Mahela banks, and followed by small scale industry. SIDBI is there, and also industrial development. IDBI bank is there for. Microfinance banks are there. Small credit of amount will lend to the rural people, below poverty line people, uplift the life of the below poverty line people. So lending money to the microfinance, small finance, micro, not a macro, microfinance. This all coming under banking system. These all commercial banks, all the banks were monitored by Reserve Bank of India. The Reserve Bank of India is backbone of our India in financial systems, very, very strong compared to other countries, because still Indian economic survey based on Reserve Bank rules and regulations. Reserve Bank monitor all the banks. Reserve Bank push the banks to follow the rules and regulations based on CLR, SLR, and many variables were many useful terms and conditions followed by monitored by Reserve Bank of India, particularly commercial banks. The people deposit money in any banks. Bank where bankruptcy where happen, bank will be bankruptcy means bank will not failures. That's called as bankruptcy. We don't bother about anything because our money pay back to the Reserve Bank of India. This is not be happen in other countries. Any central bank will give assurance to the depositors. You can invest anywhere in our countries. We assure you, bank failures will happen. We will you repay your money along with the same interest rate. The assurance given by the Reserve Bank of India, that much strong positioning financial system in India, strong financial systems in India. So banking system refers success of commercial bank, investment banks. You people may know about investment banks. Investment banks means merchant banking activities. Investment bank means the banks specifically attract the customer. They are borrow money from the depositors, like investment banks, not a fixed deposit. They borrow money along with the demat account, open the demat account on behalf of the customer. Bank will purchase the stock and sell the stock on behalf of the customer. That is called investment banks. Banks also collect mobilizing money from the public, not only lending money to the customer, and also they are investing money to the stock market investment, gold investment, and followed by real estate investment, and followed by many investment avenues available in this world. They invest money in foreign countries. Which economy is a good economy? They invest money in foreign countries because they deal with foreign currencies. That is called as investment banking. Central bank means Reserve Bank of India is called as central banking. Commercial banks accept deposit lending loans and advances. Investment deal with capital market and tradings, and the central bank regulate the banking system. We clearly mentioned. I'll already start from the class. I clearly mentioned commercial banks accept deposit and lending loans in advances. Then investment deal with the capital market, that's the stock market and trading activities. Central bank regulate the banking system by setting monetary policies. That's very, very important. Monetary policies. They strictly follow the monetary policies. Strictly follow the monetary policies. Suppose if you take it as an example of Europe or a federal bank in US, all the banks were different. They are coming under federal bank, but risk taken by the banks their own itself. No. Central banks are federal bank. Federal bank never ever to connect with that domestic banks, national banks in America. Any failure occurs, federal bank not repay money to the customers because all the risk taken by the bank itself. Either they can raise the interest rate or reduce the interest rate. They can follow their rules and regulations, own rules and regulations. But federal bank, they monitor the American banks. Anything happen to the customer, federal bank never give assurance to the depositors. But in India, totally different. Because all the banks coming under Reserve Bank of India. All the banks should follow the monetary policy of Reserve Bank of India. Anything happen to the banks coming under failure, the money will be paid back to the customers. They're giving confidence to the customers by RBI, Reserve Bank of India. You can't bother about your deposit, you can't bother about your interest rate. RBI will take care of all the responsibilities, but it is not same applicable to all the countries. That's why our Indian banking system is very strong compared to other banks. Example, if you take the example, 2008 financial crisis were happening throughout the globe. That American financial crisis were impact on global economy. That's 2008 crisis we called as bank crisis. 2008 big crisis were happened in America. All the big giant banks were failure in America. Lehman Brothers and many banks were failure in 2000 crisis. But at time also 2008 also India is showing the strength to the world, outside world. Our India will maintain the 8% or 9%, 10% GDP at that time also. Even global economy will be failure. Subprime crisis. That name of the crisis name is subprime crisis. So at the time also India will strengthening their even global crisis were happened. Even India banking system is very strong system. They maintain the GDP based on Indian banking systems, monetary policies. So that's why we discuss on commercial bank, investment banks, and followed by central bank monetary policies very strong in nature in India. What is banks? Banks coming under Indian Act, Company Act 1949. You can, you always remember the year is very, very important. Act year. Indian Banking Company Act 1949. You always remembering Indian Company Act 1949. So, what is the business we are doing in India? Accepting of deposit lending loans, issued and paying checks, collecting the checks on behalf of the customer. These are the three major services done by the Indian banks. Accept of deposit and lending loans, collecting, mobilizing money from the depositors, and also the deposited money, they will not keep it in idle. That money will be, you keep it in idle, that money value is no value, money value is no value. For that purpose, they identify the people, need of money people, they identify the need of money people, they're lending loan to the borrowers. Within that, borrowers pay interest rate along with the loan. Bank will generating income from that loan amount only. That is called as loan is the asset of the bank. Deposit is the debit of the bank. Sorry, not debit. Asset, liability of the bank. Loan is asset of the bank. Whenever bank will lending money to the borrower repaying money to the banks along with interest rate. Bank also generating revenue from that interest rate only. Within that interest rate, they are repaying money to the depositors along with their deposit amount, along with interest rate. This all should be generating a revenue income from this loan only. So always asset of the bank is loan, liability of the bank is deposits. So that is called as accept of deposits and lending loans. Then issuing and paying checks. Many people issuing and paying checks. Then nowadays, that issuing and paying checks will be government of India and all the banks will reduce that work, issuing and paying checks, because we are doing RTGS, real-time gross settlement, then NIFT, National Electronic Fund Transfer, and followed there many services available to transact money to one and one to two and one to many people. So issue and paying checks, and also the previous year 6-month validity time they are giving for issue and paying checks. The checks validity period is 6 months, and then MICR number is very, very important, because checks and also money is same. Checks and money is also same value. Nothing but checks, money, currency equal to checks. So MICR number is very, very important. That's a code number. And then collecting checks on behalf of the customer, So because two banks were exchanging the checks with equal amount, that is called as different area is there. All the banks sit together. Their collection of checks, they are exchanging the equal money of the checks, equal to the checks. Concept, that is the collection checks on behalf of the customer. That duty also done by the banks. Students, my voice is audible. Hello?
Yes, sir, you're audible.
Okay, thank you.
Yes, sir. Yes, sir. Audible.
Okay, thank you. Then history of modern banking can expect from 5 more questions. History of means again go for 18th century. General Bank of India was started. Then 1786. This is history of modern banking in India. After 1935, Bank of Bengal, Imperial Bank of India. Finally, all the banks were combined together. Bank of Madras, Bank of Bombay, Bank of Calcutta. This was the 3 banks were main banks in India. Bank of Calcutta, and previously, because we are British people were ruled by our country, 1947 before, the 3 banks were main banks. The 3 capital was main capital for British people. Calcutta, Madras, and followed by Mumbai, because these three areas were connected with the seashore, export import purpose and all other activity purpose. They were using these three important areas, Bengal, Mumbai as well as Madras is a capital of South region for Madras. They were monitored. For that purpose, they started Bank of Bengal and followed by Bank of Madras and Bank of Calcutta. They were combined together in 1935. That is called as State Bank of India, 1955. State Bank of India. Now our state banks have more than 12,000 branches all over the world. Huge banks have in State Bank of India. 1955, they became the State Bank of India. Then 1935, Reserve Bank was established. 1935, because we want to monitor all the banking transaction activities, because we are deal with public money. That's very, very important. Deal with public money with the effort of British people. They found central bank for India, that is called as Reserve Bank of India, 1935. Then that phase will be between 1913 to 1948. 1,000 smaller banks were joined together. The reforms were happening in Indian commercial banks. They came up with the 1949 Banking Act. Then after all this should be done, only elite people were using the banking services in India. Middle class people and below low to poverty people, and followed by small scale industry people, small entrepreneur, woman entrepreneur, and other people never enter into the bank. And thanks to our former Prime Minister Indira Gandhi. Indira Gandhi later changed the systems. They combined all the banks were coming under nationalized banks, private banks, and followed by other banks. All the banks coming under nationalized banks. In 1969, I think, Reserve Bank of India extensive power. 1969, that was a major reforms were happening in India. Major revolution were happening in banking industries. According to the banking companies, acquisition and transfer happened in 1969. Bill were passed by the parliament. So all the banks were, 18 banks were, national banks were announced by our former Prime Minister Indira Gandhi. Before that, only elite people were entering into the banks. The other people never ever entered into the banks. After this major reforms were happened, 1969, 14 major Indian commercial banks, country were nationalized banks announced by our former Prime Minister Indira Gandhi. Then again, in 1980, another 6 banks were nationalized, and total 20 banks were nationalized by 1969 to 1980s. Where happened, 20 nationalized banks were announced by Indian Government of India. Government of India announced the nationalized banks. So after that, what reforms were happened, all the people were entered into the banks. Even though we cannot reach the bank, we reach the bank financial service to the poor people. Still, gap is there in India, because we are more than 140 crore people. Among the 65 crore people belongs to 67 crore people belongs to women people. More than 73 crores belongs to men people. Still, we are not reached the customer in times of financial services like insurance services, bank savings account, credit lending loan to the customers. Still, we are not reaching to the customers. That's why we introduce financial inclusion. All the people coming under one umbrella. Financial inclusions, who are all exclusive from the banking services, that people coming under financial inclusions. Still, the effort will put by the government of India. Still, they want to reach the people. They introduce Aadhaar, they introduce Mudra, they introduce 100-day employment opportunities for poor people, rural people. They want to develop the rural economy. That's very, very important. For that purpose, they introduce microfinance, develop the rural economy, not only rural economy, rural employment opportunities, standard of living for rural people, and education, and followed by health, then insurance covered by health insurance. All these activities done by the government of India based on many schemes, welfare schemes were introduced by government of India with the help of bank support. Because all this should be happen transactions, money transaction, all the transactions should be recorded, even domestic transaction or foreign transaction. All these services are done through banks only. Done through banks, either the private banks or foreign banks or rural banks or cooperative banks or commercial banks, government nationalized bank, microfinance banks, NBFC, non-banking financial institutions, whatever services provided by the to reach the to reach the people in terms of financial services. That is the main aim to introduce 1969 all the banks, 14 banks after 1980s, remaining 6 banks were total 20 banks were nationalized in India. Then what happens after 1990? One of the major reforms were happened in India that is called as LPG, liberalization, privatization, globalization. Liberalization, privatization, globalization. After the reforms were happened, uh, these reforms in terms of all the banks, major banks were announced as a commercial banks, major banks were announced as a nationalized banks in India, 20 banks. All the banks were running in terms of physical branch banking activities. Physical branch banking activities. In 1987 only they introduced ATM bank. And that too, HSBC were introduced ATM banking activities in India. We never ever we are using it in our computerized banking system in India. That's why quite difficult. We are running the bank like a motor branch, like physical table, chair, books, notes. They maintain in terms of physical branches. After 1993, the new regulations were Government of India introduced Narasimhan Committee, the Banking Regulation Act amended in 1993. The gateways of new private sector banks were open in India. 1993, already told liberalization, globalization, and privatization. We are living in global village. We are living in global village. Nowadays, we are connecting to global. All the business activity we are connecting to global. You need any product, you need any product or any services through mobile phone, you can access your all these services. That's why we are still living in global village. We are connecting the global economy. Any country economy fall down, the totally impact on the global economy. American economy fall down means that will be impact on Indian economy. Indian economy fall down means American economy also be affected. China economy fall down means Indian economy and followed by global economy were affected. So nowadays we are connected together. We are connected together. We are integrated together. Business, national economy along with the global economy integrate together with the help of technology. With the help of technology, domestic economy, national economy, global economy integrate together with the help of technology. So export import is very important. Export import is very important. For everything is very important means we are open the gateway of privatization, globalization, and liberalization is very important. The following major steps were taken by the government of India to regulate the banking industries. 1993, new things, new revolution were happened. India were opened the LPG. With the help of the LPG, all the private banks were entered into Indian market, Indian economy. So after that, they are entering to the Indian market. All the banks were computerized banks, centralized banking systems were implemented in 1993. Previously, suppose you put a check in the banks, it would take 15 days to settle the amount to the customers, one to one, so person to person. P2P. After central banking system activity, all the banking activities should be computerized. Central banking activities were introduced in India. Within a day, the amount will be settled to the clients, person to person. They deposit the money, they withdraw the money. It will be easy accessible and easy services and reduce the time, reduce the work. All things should be happen. Major reforms were happened in 1993. Then the major following steps taken by the government by India. 1949, enactment of Banking Regulation Act, already I told, enactment of Banking Regulation Act were happened in 1949, and also 1935 they introduced Reserve Bank of India. After that enactment of Banking Regulation Act, they introduced after our freedom, 1947, Bank of Madras, Bank of Calcutta, Bank of Bombay were joined together, called as a State Bank of India. 1955, the reforms have happened. Nationals of all State Bank of India. The 1959 nationals of SBI subsidiaries, Bank of Baroda, Bank of Trivankur. This all coming under SBI subsidiaries in 1959. Then 1961, they were introduced insurance covers extendable to deposits. Insurance covers extended to some deposit. You can deposit more money, 5 crore, 10 crore. Insurance extendable for deposit monies because anything to be happen, disaster will happen. Insurance coverage is very, very important. Then 1969, the big revolution that happened in India that is called as nationalized banks, 14 major banks. In 1971, creation of Credit Guarantee Corporation. That's very, very important. Creation of Credit Guarantee Corporation. Credit amount monitored by creation of credit. Creation of credit means you can create more borrowed amount. Guarantee Corporation, then followed by creation of Regional Rural Bank, 1975 happened. Creation of regional RRBs with the development of rural areas. The 1980s, nationals of 7 banks with the deposits over to 200 crore, minimum is 200 crore to open the bank in India. That is, major reforms were happened after 1993. Private banks were entered into India, and present day after private banks were entered into India, ATM banking followed by SMS banking, followed by internet banking, and followed by internet banking, SMS banking, mobile banking. Nowadays, in previous years, many failure will happen for bankings because they don't have a separate application for every bank having separate application. All the mobile phone do not have that application. That is one of the biggest failure in banks. Now with UPI, connecting with UPI, you can common application for all the mobile phones. You can using that bank application that will be useful for your mobile app, common mobile app to all the banking activities. So they freely, continuously, they are transfer money easy to the customers, person to person. They exchanging the currencies. This the major reforms that happen in India. Then nowadays they introduce AI, artificial intelligence, blockchain technology, machine learnings, many new technology, robotics, many new technologies were introduced in the new era. So what are the reforms that happen? That's the technology reforms that happen in banking system because particularly they introduce in banking systems because cyber crimes is more in banking system. We are dealing with public money. We are dealing with public money, public currencies. We are we are protecting the public money. Banks were protecting the public money in terms of safety and liquidity, risk. Everything should be maintained by the bank. Safety, risk, and followed by liquidity. These are the interest rate. These are the main variable to protect by the customer by banks. The new generation banks, or the UTA banks, Axis Bank, ICICI banks, HDFC banks, and followed by foreign banks like City banks. Many foreign banks were running in India. Those are the new era. That is, the new reforms were happening in India. Then functions of banking: primary functions, secondary functions. Accepting deposit, lending loans. That's the primary function. Already we discussed accepting deposit, lending. Secondary function, agency functions, financial services. Accepting deposit, we don't want to give more explanation regarding accepting deposit. So like its CASA account is very, very important. CASA means two types of deposits are there. CASA, current account, savings accounts. Current account, that is also types of accepting deposit from the banks. Current account means business people will open the current account to the banks. Savings account means suppose if you want to open the bank account, you maintain the minimum balance. That's called a savings account. Suppose you want to do the transaction of money. So accepting deposit means from the deposit which usually expire in fixed period. That is called as fixed deposit, recurring deposit, and followed by recurring deposit. Current deposits, the fixed deposit and recurring deposit. Current deposit means you can open the account for business purpose. That is called as current have no restriction withdrawal for money or money. That is called as current deposit. Then Fixed deposit for specific period, time period is very, very important. 6 month period, 1 year period, 5 year period, and 10 year periods. You can depends upon your customer preference. They are going for fixed deposits. Based on that fixed deposit, interest rate also be repaid to the banks. Then recurring deposit. Recurring deposits normally is operated based in the salary account. Salary account people. That's a recurring deposit. Specific period or specific month, you can deposit your money for 1 year or more than year. Interest rate also be there. Suppose you do not allow withdrawal before the expiry of the period. That's very, very important. Recurring deposit. Fixed deposit, anytime you can allow their expiry period, expiry date, anytime can allow them withdraw your money. Because why we deposit the money? For our requirement only we deposit your money. Anytime you need our money, you can withdraw your money. But recurring deposits rule is strictly followed. Before the expiry period, you cannot withdraw that money. That is called as recurring deposits. Lending loan and advances, ODs, OD facilities, you know very well about OD facilities. How many of you know about OD facilities that I know? So you are a current account holder. You are a current account holder. You can do a business in, you are doing business. New entrepreneur, all the entrepreneurs are doing business. You can maintain the, you can maintain sufficient money, more money in that current account. That is overdraft, or you can your land or any other property you can equivalent to cash 50 lakhs or 1 crore. You can that land or property will be issued in banks. Along with that, a bank will allocate money for you. That is called as overdrafts, because everyday transaction purpose you need money. One times you need 5 lakhs money, 10 lakhs or 20 lakhs, 30 lakhs, 40 lakhs, 50 lakhs. Based on the properties, they are allocating money on overdraft. That is called as OD for the business people. Day-to-day transaction that happen in the business. One day they are need 1 lakh, other day 5 lakhs. Based on that, your value of the property, bank having the holding of the property, according to the property asset, asset converted to cash. That asset converted to cash, that equivalent cash, they are lending money to the, for business purpose, the bank lending money to the, in terms of OD, overdraft to the customers, business people. Then cash credited. Cash credit means facility extended by banks, current account holders, current account holders. Cash credit, the lending money to the, in terms of overdraft, that's an OD again, usually for a longer period than overdraft. That is called as cash credit in longer period. Loans, normally you know that loans, types of loans, short-term loan, long-term loan, and also medium-term loan. Like a loan means what other loans are available, vehicle loans, home loans, personal loans, unfunded business loans, individual loans, many loans, agricultural loans, many loans are available. That is called as loan. These are the services provided by the banks. That's why we call this primary services. Primary services. Then the secondary services. Secondary services means agency functions. What are the agency functions? Agency function means agents include transfer of funds, collection of checks, periodic payment, periodic collection. These all should be done by agency functions. Agency function. Banks also work as agencies. They're going to collect money from the bank loan from the customers, and the collection check from the banks, and periodic collections, and also they act like a portfolio manager. Portfolio manager means act like a portfolio management means they are mobilizing money from the public in terms of deposit. That money will be lending in different sectors. That is called as portfolio. They never ever lending money in only one sector, because one sector will give interest rate and other sector will not give other interest rate. That is very, very important. One sector performed well, other sector not performed well. So they are deposit money not only for one sector. They are deposited money. They are lending money in different sector. One is for security, capital market instrument, and followed by gold, real estate, and foreign exchange currencies, and commodity services, and also Many sector they invest money, mutual funds, because one sector is failure, other sector will be performed well. They match the interest rate. That's why we called as portfolio management. Portfolio management, diversify your investment. That is called as portfolio management. All these services provided by the banks. And collection of checks already discussed. And the safety other general utility function is overdraft, traveler checks, letter of credit. Suppose you are doing business, export and import service, they are issuing letter of credit on behalf of the exporter. They settle the amount to the exporter. On behalf of the importer, they settle the amount to the exporter, because importer, after collecting all the products from the import, then only selling the product to the customer. After only they receive the profit or capital amount to settle the amount to the exporter. Before itself, bank will, on behalf of the importer, they settle the amount to the exporter. That is called as letter of credit, because we are dealing with foreign currencies. Present days, dollar value is 83 rupees and 45 paise, and tomorrow will be rising or reducing. So that risk will be taken by the banks. That is called as a letter of credit. Then safety locker facilities. Many people will know that safety locker facility. All the valuable document and from the gold you can lock in the bank locker. That is called as safety locker facilities provided by the banks. And the underwriting of shares and debentures. Suppose private company were issuing the shares, issuing the equity shares to the public with the help of banks, with the help of merchant banks. Banks also act like a merchant banks, commercial banks also act like some merchant banker or underwriters. On behalf of that company and on behalf of the customer, bank will issue share to the public. That is also one of the services provided by the banks. And dealing with the foreign exchange, already I told you, dealing with the foreign exchange. Banks were dealing with the foreign exchange. Just now we are talking about letter of credit, import and export. And also you are invest money in foreign countries, or NRI will invest money in India. Our Indian people were invest money in foreign countries. All these with the help of banks, our banks will take all this responsibility on behalf of the customer dealing in foreign exchange. Then project reports. Suppose you want to do a big projects. If you want to do a project like you want to expand your company, you want to start a new business, or either you can borrow money from the foreign companies or borrow money from the banks. You don't have in your hand in project how to write the project, how to borrow money from the 5,000 crore or 1,000 crore, because you have a valid project. Then how to borrow money from the banks is quite difficult for you, because it's a question mark. With the help of banks, you can borrow money from the banks. That is called as project report prepared by the banks with the consulting service. And the social responsibility program, that means they can create a awareness program among the public. Literacy rate want to be increased, financial literacy rate want to increase, they create an awareness program among the public. That is called as social responsibility program. And also blood donation camps, maintenance of school parks, and everything is done by the bank. That's the social responsibility. Then other utility functions. Then types of banks. What are the types of banks? Regulatory setup by the prevailing in a country. The types of banks is impact of LPG is there. Banks are classified into various types, like organization setups, ownerships and function performed by the banks. After LPG, everything changes. This question you can expect from your 10 mark questions. Without this question paper is not there. So types of banks based on structures: unit bank, branch bank, group bank, chain bank, and correspondent bank. Based on the ownership: public bank, private bank, foreign bank, and cooperative banks. Based on the function: savings banks, commercial banks, industrial investment banks, agricultural and land development bank, cooperative bank, regional rural bank, exchange rate bank, indigenous bank, and consumer bank, and from a central bank. This is the types of banks and also bank structures. Based on the structure means unit bank, single bank, that is called as unit bank. Then branch banking, you know that branch banking. Every bank having separate branches in these countries. That's a branch banking. Then group of bank, like take this example of SBI subsidiaries, that is called as group banks. Then chain banks, then correspondent banks. Differently, they correspond different banks. That's a correspondent bank based on the ownership. National Bank owners are public, and private banks based on the private people where the ownership of private banks, and foreign owners were ownership of foreign banks, and cooperative banks that cooperatively the people and also government join together, that is called as cooperative banks. And then based on the function, savings banks, commercial banks, industrial and investment banks, you know that savings banks. Then commercial banks totally based on business. Industrial banks, the banks lending money to the for only industry purpose. The banks, investment banks, the banks were involved in capital market investment. They investing money in different sector, capital market, commodity market, currency market, and followed by foreign exchange market. All these market called as investment banks, like equity share, debentures, and also followed by equity share, debentures, preference shares, equity shares, these all coming under investment. Then agricultural bank, separate banks were run by India. NABARD, National Agricultural Development Bank of India, and DAL development banks also be there. Regional cooperative banks, RRBs were there. Exchange bank, Exim bank, export and import banks coming under exchange banks. Then consumer bank and followed by coming under central bank. Central bank is called as Reserve Bank of India is called as central bank. So thank you people. Today's session is over. So we will discuss by tomorrow.
Okay, thank Hello, good morning, all of you. Hello.
Good morning, ma'am.
Very good morning.
Good morning, ma'am.
Very good morning.
Good morning, ma'am.
Very good morning. 1 second, I upload my PPT. இங்கேம்மா வந்து தொலையா. ஸ்லோவா இருக்கு சிஸ்டம். சிஸ்டமே ஸ்லோவா இருக்கு.
ஏன் என்னாச்சு? இல்ல இப்ப கிளாஸ்ல அவங்களுக்கு லேட்டா தான் கிளாஸ் இருக்கு. வாங்க வேணாம், வந்தா அப்புறம் வாங்கிக்கோங்க சொல்லுங்க.
Hello, can you see my PPT?
இல்ல இல்ல சார் பேசிட்டாங்க, நான் வரேன், கீழே வரேன்.
Can you see my PPT?
Yes, ma'am.
Okay. Let us start. Management accounting. Management accounting, already you have studied in first semester accounting for manager. In accounting for manager, you have studied basic accounting concepts, conventions, rules, then journal, ledger, trial balance. These are the basic fundamental accounting. In addition to that, some of the cost accounting chapters, and then management accounting decision making problems also we have learned in first semester also. You are a finance student, so you should have thorough knowledge about management accounting, because you are a finance manager. You have to take in-depth decision making of management accounting, right? So management accounting elaborately we are going to study in this subject. Okay, so what is management accounting? Management accounting, which includes various methods, concepts, techniques, planning, and then various alternative actions, business alternative actions, everything you have to bring into one control through evaluation and interpretation of your performances. That is called management accounting. So, what are the characteristics of management accounting? It provides accounting information and then cause and effect relationship. This cause and effect relationship means what? Say, for an example, controlling of cost. Say, for a material, how much you are expected to spend, but how much actually incurred. So, what is the adverse or favorable situation? Why it has been incurred more, what you have expected. So that is the, you have to find out what is the cause and effective analysis. And then special technique concepts. Special technique, that is, say for an example, budgetary control, marginal costing, standard costing, these are all the management technique to control, to see the applying the taking decision making, right? Next, decision making. Decision making is the very important aspect of management accounting, right? So you have to study the various historical financial data, and then you have to take decision making for future. So while taking decision making for future, the management helps to decide various parts of activities, right? Achieving task, no fixed norms, increasing efficiency, informative instead of decision making, forecasting. So these are all the characteristics of management accounting. The next one, objectives of management accounting. What are the objectives of management accounting? That is planning and formulation of policies, controlling performances, interpreting financial statements, motivating employees. So why we have to, what is the purpose of we have to keep management accounting? First of all, any organization should have right planning. Start with planning, budget planning. So if you are purchasing machinery, so you have to have a capital budgeting. So what are the various machineries assets are available, alternative sources. So what are its income source? So what is the minus plus, all the things you have to analyze. First of all, you should have planning. So process of planning and formulation of policies. See, first you have to plan, then you have to formulate the policies, and then wherever relevant information is required to achieve the target, so you have to frame the policies, right? Then controlling performance. Management accounting is the, we can take it as a technique or tool for controlling your cost. Say for an example, budgetary control, standard costing. These are all the controlling techniques we are using while taking decision making. Interpreting financial statements. Interpreting financial statements, that is, management accounting provides relevant information in a systematic way that can be used by the management in planning and decision making. Say, for an example, fund flow, cash flow. You have to interpret what is the cash flow increased or decreased, fund flow increased or decreased. Fund flow, if it is decreased, means that it is an alarm for insufficient working capital. So you should have sufficient, you have to take decision making, sufficient capital, you have to keep it in the business. Then ratio analysis, trend analysis, and comparative financial statements are the tools normally used in management accounting to interpret and analyze accounting data. Right? So, motivating employees. A management accounting motivates employees to improve their performance by setting targets and starting incentive schemes. Right? So, management accounting motivates the employees to improve their performances by way of motivating a
Excuse me, ma'am. Sorry to interrupt. Can you please change the slide? You're on the same slide.
which one ma? This one.
Yeah.
What do you want in this?
You didn't change the slide. It's on the first slide only.
No, I'm changing. Keep on changing.
Okay. Yeah, got it, ma'am. Thank you.
Okay. I put it in the show, sliding show. Making decisions. Uh, can you see right now? Yes, making decisions. So making decision, you have to take the decision making. Say for an example, make or buy decision, whether to export or not. Because export, when you are exporting, we have to sell it in the cost, selling price lower than the domestic price. So whether to accept that order or not, so whether to continue or discontinue the production of some part of your business. So you say various marginal costing decisions you have to take. So the decision making problems or decision making uh, activities you have to, it is very helpful, right? Then reporting to management. So very, the primary role of management, that is various functional activities are the production management, purchase management, financial management. So many activities are the functional management. So each and every activities that should be reported to the top management. So the role of management accounting to give advice to the management to take decision making in various activities, right? Then coordinating among departments. So coordinating, when you are coordinating means you have various activities are there. So once you have taken decision making or preparing budgeting, how much should be the production, how much should be the purchases, how much should be the keep it in stores, how much should be the supply, how much you have to sell. So all these things, budget, once master budget is prepared, according to that you have to give instruction and coordinate with the all departments, all activities, right? Administrating tax. So management takes guidance from the management accountant according to the law. So what is the tax to be paid? There is no relation with the management accounting and taxation, but they can take advice. Why? Because whether that profit earned during the year, whether to total profit earned given to shareholder, or we can pluffing back for future expectations. Some management decision making they can take. If we have 100% dividend payout ratio, what will be the effect, what is the consequence of company share price? So like that, so many in-depth decision making you can take, right? Next, what are the tools and techniques of management accounting? So, what are the tools and techniques we are using while doing the management accounting? What are the things here? Some tools are given. See here: financial planning, financial statement analysis, decision making, standard costing and variance analysis, marginal costing and CVP analysis, responsibility accounting, discounted cash flow, learning curve, ratio analysis, statistical and graphical techniques, fund flow statement, cash flow statement, value analysis, risk analysis. In addition to that, various decision tree, so many latest tools also there that we will see in that last unit. Okay. Okay. Now you know thoroughly what is financial accounting, what is management accounting, right? So, what is the difference between these two? Can you say, anybody? What is the difference between financial accounting and management accounting? Anybody? Anybody? Yes. Financial accounting gives you only the historical, recording the historical information, right? What has happened, that is recorded in the books of account, that is called financial accounting, right? But the management accounting, what they are doing, obtaining the data from financial accounting, and based on that they are making so many, applying so many tools and techniques, and then taking decision making, right? Financial accounting, it is recognition, classification, recording, that is financial transaction, actual, that is journal, preparation of journal, ledger, final statements, final accounts, everything are preparing. Here you have to take this financial statement from the financial accounting, and you have to collect the information, and then you have to do analysis, ratio analysis, fund flow analysis, cash flow analysis. Based on these final statements only we can prepare, right? So you have to evaluate and make planning and decision making, right? Financial accounting, it is a support of relevant figures is required in preparing the financial report. So while preparing the financial report, the what is the data which is historical data which is relevant to that, that is to be given, right? So here only you have to give only subjective. What is the subjective or objective? If you want to analyze working capital, so only fund flow statement is enough. If you want to see what is the cash availability in the business, so you have to prepare only cash flow statement, right? No need to compulsorily to prepare all the things. Financial accounting, you have to record, prepare writing journal, and then ledger, then final statements you have to prepare. So many things are there, right? So here you have to, what is your objective, that only you have to prepare. And financial accounting, it is not depending upon the sound management accounting system. So financial accounting, as it is, whatever it is happened, it is recorded. There is no need of management accounting system is not required. So here, sound management accounting system is required in management accounting. Why? Because to take decision making for various aspects. What is the capital structure, debt equity? If it is debt to capital is more than your equity capital, what will happen? Dividend payout ratio, if it is 100%, what will be the effect? What is the shareholders wealth maximization will be affected or not? So all these things you have to analyze in management accounting, right? Then financial reports are used by the management of a company, shareholders, creditors, and financial institutions. Here, financial reports are exclusive. Statutory audit of financial statements is required as per applicable law. Here, no statutory requirement of audit for reports prepared by the management accountant. Then here, financial statements of a concern are prepared at the end of the every accounting period. Reports are prepared as and when required by the management of concern. To ascertain the profit or loss of a concern actual basis. So in financial accounting, we are finding what is the actual cost, profit or loss earned during this year. What is the financial position only that we are seeing. But management accounting, you have to evaluate the performances, efficiency of the management, efficiency of the workers, section wise, department wise, activity wise, you can bring out. Okay. Similarly, cost accounting versus management accounting. So, what is cost accounting? What is management accounting? Management accounting is here collects the data from financial accounting and cost accounting. It interprets and analyzes various using various tools and techniques, methodology. They are giving decision making problems to management, right? Reporting to the management. Cost accounting is also a branch of separate accounting which maintains only, it is no, it is not essential for every business concern, but in case of manufacturing concern, if cost accounting, if they are preparing, then only they can find out what is the unit cost, what is the determination of selling price, and then you have to analyze, control the cost. Once you record each and everything, you can analyze why this much input raw material has been utilized. So you have the controlling of cost is very very essential. Not only controlling, ascertainment of cost, and then cost control is the main objective of cost accounting. Management accounting is the information provided to the management in that process: planning, controlling, performance, evaluation, everything, decision making, everything, right? Then cost accounting systems uses quantitative cost data that can be measured in monetary terms. Management accounting uses both quantitative and qualitative data. It also uses those data that cannot be measured in terms of money. Determination of cost and cost control are the primary roles of cost accounting. Here, effective and efficient performances of your concern, primary role of management accounting. So here you have to determine only the performances. There you have to determine only the cost control, right? Success of cost accounting does not depend upon the management accounting system. Cost accounting system is totally different, but management accounting depends upon the management systems. Management accounting systems, say for an example, uh, top level management. Under that, all management divided into various activities, functional activities: purchase department, production department, sales department, marketing department, like that, right? Then cost related data obtained from the financial accounting is the base of cost accounting. Management accounting is based on the data as received from financial accounting and cost accounting. So here provides future cost related decisions based on the historical cost information. Provides the historical and predictive information for future decision making. In cost accounting, it reports to the management also, and also they can report shareholders and creditors of the concern. Here, management accounting prepares reports exclusively meant for the management. Here, only cost accounting principles are used in it. Here, principles of cost accounting and financial accounting are used in the management accounting. Sorry. Statutory audit of cost accounting reports necessary in some cases, and especially big business concerns, right? Here, management accounting, no statutory audit is required. Here, cost accounting is restricted to cost related data. Management accounting uses financial accounting data as well as cost accounting data. Next one is responsibility accounting. Responsibility accounting you might have studied already in cost accounting. Cost accounting, it is a division of responsibility accounting is a center. That is, responsibility is centered in various activities. Say for an example, accountability. To what is the purpose of creating responsibility, you have to fix the accountability from each section, each department, each activities. So that is why the responsibility accounting is created. So responsibility accounting, under that you have to there are various levels of managements are there. So between various levels of management, they have to create responsibility and then accountability. If why it is not completed, once you are fixing the responsibility, giving the delegating the authority to that particular person, automatically accountability will be there. Otherwise, he has to answer why the production did not achieve 1,000 units per day. Like that, you can question. They have to answerable. That is the accountability, right? So you have to fix the accountability. For that, you have to delegate the authority, and then responsibility centers you have to create, right? So that is called responsibility accounting. Under the system, divisions are units, small units or small divisions in the organization, that is the specified in the authority, that is development of responsibility centers, and then evaluated individually their performances. So you can evaluate the individual performances easily, and also transfer pricing is transfer pricing, you might have heard that we will study in elaborately in last unit. The transfer pricing is the very essential establishment of performances and the responsibility center, right? Transfer pricing is nothing but in one organization, manufacturing concern, there may be a various processes may be there, right? One unit process for a finished product might be the input of another unit, right? That second unit finished product will be the third unit input, right? So when they are finished the product transferring to another section, they have to fix some selling price, that is called transfer pricing, without adding profit or not. So that is called notion profit, we used to say. That is called transfer pricing, right? See, some definitions I have given. Responsibility accounting is a system of accounting that recognizes various responsibility centers throughout the organization and reflects the plans and actions of each of these centers by assigning particular revenues and cost to the one having the pertinent responsibility. It is also called profitability accounting and activity accounting. So, what are the requisites are required for while fixing the responsibility accounting? I have given it here. Just go through. So, what are the features of responsibility accounting? That is positional accounting, focus on controllable and non controllable cost differentiation, control rather than mere accounting, not an accounting by itself, transfer pricing, performance evaluation, dropout or continuation of decision making. So, the responsibility accounting features are positional accounting, focus on controllable and non-controllable cost differentiation, because cost some cost may be controllable, some costs may not be uncontrollable, right? May be uncontrollable. So in that case, how to divide, how to reduce that? So all these things comes under this responsibility accounting. For that, we used to say ABC costing, activity based costing, drivers. We used to fix per driving activity, what is that cost, like that, right? The next one, what are the steps involved in the responsibility accounting? First, you have to identify the responsibility centers. So, what are all the responsibility centers are there in your organization that you have to identify? Generally, responsibility centers divided into four categories. That is cost center, revenue center, profit center, and then investment center. So, well, you have to next you have to delegate the authority and responsibility, or you have to decentralize the power. When you are decentralizing the power to the small management, that is functional managers, so automatically the accountability will be built up, created, right? The next, controllable of the object. Once you are fixing that responsibility, automatically controllability automatically will be created, right? Then you have to establish the performance evaluation criteria. How you have to create, say for an example, standard costing. If you are taking standard costing, you have to fix what is the budgetary, or what is the, if you are producing one unit of output, how many units of input is required, Like that, you have to how many workers are required, how many working hours, how many machine hours are required. So all these things you have to establish uh, for the systematic controlling system, right? See here. You can apply your divisional performances through standard costing, budgetary control, profitability ratios, and then valuation measures. Right? Then electing a cost allocation basis. So cost allocation, you have to allocate, say for an example, how much units of power you are allocating to department A, department B, or machine 1, machine 2, like that. So that allocation basis also you can, how many hours they are using in factory 1, factory 2. Based upon allocation also some cost ascertainment may be taken, right? The next one, advantages of responsibility accounting. So what are the advantages of responsibility accounting? First you have to take various ways to manage large division of organization. So some big organization, there may be various divisions, various departments, various sections. So many things are there, you have to divide it into various pieces or various segments. So in that various segments you have to first of all you can get clear idea about what is their role, what is their responsibility. So all these things you can fix it. Then provides incentives to departments manager and individuals to optimize their individual performances. Then provides managers with the freedom to make local decisions. Then provides top management with more time to make policy decision and engage in strategic planning. It allows management to avoid understanding the system by using a top-down remote control based on accounting measurements. Supports management and individual specialization based on comparative advantage. So, what are the limitations of responsibility accounting? So, the limitations, once you are fixing the responsibility, so it will take time to make the system. You have to make the system, and then you have to prepare organization structure, sound organizational structure, and then each responsibility centers you have to create, and then you have to delegate the authority properly, and then that should be our monitor or supervisor cadre. You have to fix it. So many cumbersome processes are there, right? Then see here, what are the types of responsibility centers: cost center, revenue center, profit center, investment center. So cost center, the manager of this manager is the responsible for costing. So in this, any decision making that will affect the level, right? So revenue cost, so revenue centers in that the manager is responsible for this revenues. Revenues means automatically sales, right? So inputs, output, finished product, how many units to be produced. So that responsibility automatically will be created to this center, this profit center. Profit center, the manager is responsible for both cost and revenue. So what is the profit or loss that is to be making decision making. In investment center, the manager is responsible for purchasing plant and machinery and other assets, right? So that is the investment center's responsibility. See here, cost center denotes the location, function, or items of equipment in respect of various cost may be ascertained and related to cost unit for the purpose of control. It is the smallest organizational subunit. For each separate cost allocation is attempted. Cost center is represented organizational span for separate cost determination of the deciding management. So it is measured in terms of financial terms, performance statement, and then directly attributable or controllable by the concerned cost center. So these are the things comes under the cost center. Revenue center may be defined as operational responsibility. Operational responsibility is production. right? So is denoted to raising revenue which no direct accountability for the cost of goods and services and sale of operation. Marketing and sales centers therefore rightly categorized comes under the revenue centers. So marketing and the sales center is the expectation of manager. They are the responsible for that, how many units to be sold, so that responsibility they have to take up, right? Then profit center under that both cost and revenue is a part of the both cost and revenue. It may be a we can say uh, whenever it is necessary to have units of an organization to which both revenue and cost can be separately attributed. Managers of profit centers should be responsible both for the revenue as well as cost, which implies sufficient decentralization of authority within the organization. Profit center manages to make decision making. Then investment center. Investment center under that the profit center performances measured by the return on capital employed. Investment center. So investment center under that capital decision making, plant and machineries you are purchasing. So in that case, the investment center is responsible for fixing the alternatives. What is the revenue will be generated out of that? So all these things they have to take decision making, and then their responsibilities comes under that investment centers. Right. Next one, transfer pricing. Transfer pricing, already I have told you, know, that is what is transfer pricing. That is in various process or various segments will be there in any concerns. One unit of output will be the input for another section or another processing unit. So when one unit is transferring into another section, that is called transfer pricing. That is called that price. Sometimes they may transfer it on cost price or adding some profit or selling price, market price. So many things are there, right?
এই বট প্রসেসটা একটা উৎপাদ এটা তুলে নিয়ে
So
স্কুলে
transfer price.
ওই কর্নারে বসে দেবো, ছায়া হয়ে যাবে আমাদের স্কুলে। ওই পাশটা এই পাশটা রাস্তার ধার থেকে। হ্যাঁ বাসিনের মধ্যে বসাবো, ওই সাইডে বসাবো আমাদের ঘরের ওই পাশে, বিশাল ছায়া হবে। এক্ষুনি আমি ক্লাস আছে তো, ক্লাসটা করে নি, সেকেন্ড ক্লাস, সেকেন্ড সেকেন্ড ক্লাস করে তুমি উপরে এসো। হ্যাঁ দারুণ গাছ, দারুণ।
So transfer pricing is a notional value at which goods and services are transferred between divisions in a centralized organization. The prices are set of intermediate products which are goods and services that are supplied by the selling division to the buying division. Goods that are received by the buying division may be processed further and before being sold to outside world as final product. So we can ask why these kinds of transfers occurs within the organization. This is because of the finished goods of one division becomes a raw material of another division. See here, if you take textile business, first what are the things are there? First you have to, there are various processes: spinning mill, doubling mill,
Hey, I give
dyeing
five.
factory, and then
I give.
somebody is noisy. Please you control it. Hasim, you control your mute your mic. Hasim, mute your mic. You can't disturb him.
কি কোনো ব্যাপার না, ওটা কিছু কথা নেই।
See there, first one, process, textile industry, if you take that is spinning, doubling, dyeing, weaving, printing, then garments. Garments is the final one, that is stitching. After that, designing. So these are the various steps are there. Spinning, that is spinning of that cotton. Cotton is the finished product for spinning mill. Spinning mill finished product will be the raw material for doubling, that is thread. Uh, Doubling raw material will be the input of dyeing section. So dyeing section, that is various finished
India play
product will
হবে না
go to
play
the
হবে
weaving
play
section.
হবে
Right? So
ওয়ার্ল্ড
weaving
কাপে তো
section,
খেলা
that
অলরেডি
cloth
হয়ে গেছে
will be the raw material of printing section. So each and every segments are there, right? So
লাস্ট নাইট
the
একটু তাহলে
output.
ওয়াচ হবে ওয়াচ
Mute your mic.
লাস্ট নাইট মানে কি গতকাল রাত্রে তাহলে ধরবে ইডি ফোনটা হবে পাঁচ ফোনটা হবে আর এটা
Nonsense. I say mute your mic.
কেন কি করেছি
Yet.
ফোন করে students stopped shouting when the teacher entered the class. Entered আছে না? Entered আছে মানে stop হবে, ঠিক আছে?
So, what are the objectives of transfer pricing? Transfer pricing objectives: divisional autonomy, and then divisional performance appraisal, and variance. These three objectives are comes under the transfer pricing. So, divisional autonomy, that is, the division manager must take sound initiative to show their division's efficiency through its responsibilities and tasks. The sound transfer pricing system acts as a motivational force, and it serves as the effective communication for such a division. This can happen when the division manager takes the action to improve the reported profit of his division, and it improves the profit. So, divisional performance appraisal. Performance appraisal, it is a profit is the yardstick for measuring the performance of particular center. So when it become a yardstick, transfer pricing facilitates to measure the divisional performances. Next one, goal congruence. So the division manager's goal must be positively correlated with the goal of organization as a whole. The decisions taken by the divisional managers for increasing their divisional profit should not affect the profits of other divisions. The transfer pricing system must serve as a motivational force to the division managers, and at the same time it should not go to the beyond level at which induce the goal of entire organization. Next one, usefulness of transfer pricing. So, what are the usefulness? That is to identify the contribution of total profit, to encourage the profit maximization, to measure the management performance, to maximize operating unit profitability, to locate profits, to minimize the taxation. So this minimization taxation, it is very transfer pricing is very big issue in international multinational corporations. Say why? Because say for example, multinational company manufacturing unit may be in one country. Its selling units may be at various centers, right? So when they are selling their goods through this transfer pricing, so the tax proportion, tax shields are different from one country to another country. So which country they have more tax percentage, they can sell it to the lower price, or which country they can have lesser, that is the tax shield is there, so they can sell it with profit. So that is why they are Avoiding taxation. Uh, this is a very big crucial issue of transfer pricing. To motivate the divisional managers towards goal congruence and to serve as a tool for control. The next one, disadvantages of transfer pricing. The divisional managers may try to achieve the divisional performances rather than corporate growth. So it creates confusion on the price of the final product due to the present disagreements on prices. It may be incurred on the additional administrative cost, arguments over disposition, and then task of eliminating book profit. So, what are the types of transfer pricing? That is cost-based method, revenue-based method. Cost-based method, actual or full cost, or variable cost, standard cost. Variable cost means only cost which is vary with the volume of output, only variable cost. Right? Standard cost means per unit total both fixed as well as variable cost. What is the cost incurred for producing one unit? Okay. Revenue-based. Hello? Ah. நான் கிளாஸ் எடுத்துட்டு இருக்கேன்ப்பா அப்புறம் பேசுங்க Azim, you are making noise, disturbing to others. First you go out. Mute your mic, otherwise go out. Cost-based method under that actual or full cost, variable cost, standard cost. That is revenue based in that you have to add some profit on that cost price. That is cost plus markup pricing, 10 percentage or 15 percentage or 20 percentage like that. There are sometimes market based transfer pricing. What is the cost which is available in the market? Market based or negotiated price, negotiated between the one center to the another center manager. So their negotiation depends upon that they are doing. Then dual pricing, dual rate method. That is it is a strategy of buying and selling. One rate they will get it from one person, another person they will get it by equal divisions, right? So this issue of transfer pricing in multinational companies is very big issues going on. You can go through latest issues in this multinational companies.
Ma'am, sorry for interrupt.
Yes.
Voice is not clear due to
The one boy is making
some item.
disturb noisy. That Azim he is switch on. Some children are something doing. I couldn't control it. Okay, we will see in the next class. First unit only theory, second unit problems, that is fund flow statement, cash flow statement, ratio analysis, all these things we will see in the next class. Okay. Now I want to close the class. I will inform our administration to close that take care of that boy. Okay. Okay. By another faculty will be informed.
এখানে আবার এর হতো না এই তো বুঝতে হবে তুই যদি লেখা তাহলে তুই কি হবে না water mix make certain for কিছু কারেকশন হবে
Good afternoon. Good afternoon. Good afternoon. Good afternoon.
Good afternoon, sir.
Actually, Hasim sir, please turn off your mic. Hasim sir. Hasim sir. Hasim sir.
Good afternoon, sir.
Yeah. I think one person has turn on the mic. It's disturbance to the class. Please inform. Hasim sir, please turn off your mic.
He is continuously annoyed since last
Good afternoon, sir.
Yeah, good afternoon. Good afternoon. Hasim sir, please turn off your mic, sir. Hasim sir.
He will not respond, sir. Please put your name if you have access.
So continue the class. Continue the class. Sudesh sir, continue the class. I will start the class.
Sir, voice is very noisy.
Yes,
Sir.
yes. Actually,
Disturbance in the class.
what
If you have access, put mute.
actually, I have some noise here. Asim sir, please turn off your mic. Asim sir.
He is not responded, sir.
So we have to start our class.
We have some disturbances. It's not.
Sir, you'll be having access to mute everyone. Can you please mute?
Hello, Sudesh sir, to start the class.
So please start. Others please
Okay.
respond. Otherwise we lost class. Entire class will
Okay, we'll start the class. Actually, our paper name is Merchant Banking and Financial Services. This is one of the hardcore paper in our finance related one, and this paper is very useful for practical and very essential for the corporate world of finance. First, we have discussed about this unit is comprising of 5 parts. First, we have to discuss about the financial services and its importance, classifications, and role played by financial services in our Indian economies. So first, after that, we have the second unit, merchant banking, and then go for mutual fund, forfeiting, and credit rating. We have continued by each one by one. And our first unit is financial service industry. And the financial services play a significant role in modern economy and the development of the sophisticated and matured financial system in India, especially in the era of liberalization, privatization, and globalization. In the year 1992, India adopted a policy called the LPG policies. After that, there is the development of sophisticated and matured financial system in India, especially in the era of liberalization, privatization, and it will lead to the emergence of a new sector is known as financial service sector. Its main objective act as an intermediary and provide a wide range of services that facilitate financial transactions and management of risk and support of economic growth and development. And the next is a classification of financial service industries. The financial service industries can be traditionally classified into two categories. One is capital market intermediaries. The capital market is deal with the long-term securities. In case of money market intermediaries, it deal with the short-term securities. The capital market intermediary consists of term lending institution and investing institutions providing long-term funds, that is mobilization of long-term funds, and money market intermediary short-term securities, including commercial banks, cooperative banks, and other agencies which supply funds for short-term requirements. Next is the emergence and development of financial service in India. The financial service sector is booming since 1992 in India, and it has passed through various phases mentioned below. That is three phases. First one is the initial phases. The period is 1960. That is a merchant. Is otherwise called as merchant banking era. That is the initial phase. That is 1960 to 80. The phase's name is merchant banking era. The second phase is 1980 to 90. That phase name is investment companies era. And the third phase, the bit of after the liberalization, 1992 until is modern service era. So the emergence and development of finance is at three stages. Initial phase is otherwise called as merchant banking era. Second phase, investment companies era. Third phase, modern services era. Asim sir, please turn off your mic, sir. Totally disturbing the class. Please, sir. Asim sir, the first phase is the initial phase. In the initial phase, there is an emergence of innovative services like merchant banking, insurance, and leasing finance are introduced at the initial phase. The functions of merchant banker start from there is two important functions. One is project appraisal and end at mobilization of funds. Once again, I have to repeat it. Maybe the sound is once again we have to start the class. The paper name is merchant banking and financial services. The first unit is about to know about the financial service industries. In India, our Indian financial system is comprising of four major elements. That is financial intermediaries, financial market, financial services, and financial institutions. The financial service sector play a significant role in modern economy. The development of the sophisticated and matured financial system in India, especially in the era of liberalization, privatization, and globalization. That is, in the year 1992, the Indian economy is opted for three policies: liberalization, privatization, and globalization is lead to the emergence of the new sector and providing not only for intermediate functions and also providing a wide range of services that facilitate financial transactions, management of risk, and support to the economy's growth and development. Normally, the financial service industry is classified into two aspects. One is capital market intermediaries, another one is money market intermediaries. In case of capital market, it deals with the long-term funds. Money market intermediary deals with the short-term funds. The capital market intermediary consists of term lending institutions and the investment banking and institutions providing long-term funds. But in case of money market intermediaries, including commercial banks, cooperative banks, and other agencies which supply funds for short-term requirements. That is two important services in the industries like capital market intermediaries and money market intermediaries. And the next topic is the emergence and development of financial service in India. The financial service sector is blooming in India, especially after the liberalization, and it was passed through various phrases mentioned below. There is three phrases. The first phrases is initial phrases. The period is 1960 to 80, is otherwise called as merchant banking era. The second phrase is 1980 to 90, that is investment companies era. The third phrase is 1990 to 2002, that is modern services era. In the first phase, that is the initial phase, otherwise called as merchant banking era. In this phase, lot of innovative services like merchant banking, insurance, and leasing finance are introduced at the initial phase. The functions of merchant banker start from mobilization of fund and also help for judicious use of fund, that is effectively and efficiently use of funds. So the function of merchant banker start from project appraiser and end as in stock exchanges is done by the merchant banker. These functions are initiated by in the beginning LIC, GIC and UTI, Unit Trust of India. These three institutions are mainly concentration is focused on merchant banking function in the period 1960 to 80. In addition to this, leasing services is also initiated in the year 1970. Leasing services was started with only for the fixed asset, that is equipment lease financing. Slowly, the leasing companies engaged other type of leasing such as financial leasing, operating leasing and buyback leasing. All these functions are done in the period 1960 to 80. That is our initial phase of financial services existence. Is otherwise called as merchant banking era. The second phase is the period is 1980 to 90, is otherwise called as investment companies era. These companies, that is the value added services like over the counter exchange, share transfers, pledging of shares, mutual funds, that is new emergence in the period 1980 to 90, factoring services, discounting, venture capital funds, that is seed capitals provided, that is the innovative capital provided by the entrepreneurs, and the credit rating are introduced in the second phase. The second phase, there is number of new instrument emergence in the field of our financial systems like underwriting functions, mutual fund, factoring, forfeiting, discounting, venture capitals. Or the major contribution to the industry is from mutual fund is the developed in the country. In this period, there is an emergence of the mutual fund era in the period of 1980 to 90, and also the capital market malpractices also coming down due to the introduction of credit rating services. There is a rating to the debt instrument and also for shares also. Initially, the rating was applied only to debt instrument, but nowadays it is mandatory for all the instrument like commercial papers, fixed deposit. All these things are credited by the credit rating agencies like CRISIL, CARE, all these things. These are emergence in our second stage. First stage, merchant banking era. The second stage is the investment companies era. The third phase, that is a modern era. In this era of post-liberalization, that is after the introduction of the liberalization LPG policies, in the era of post-liberalization, the financial service sector introduced new financial instruments in this period and a set of new institutions. During this phase, the contemporary issues like depositories, online trading, paperless tradings, all these things are introduced in this period. Maybe dematerializations. I could open an account for demat account for a purchase for listing the securities, stock lending schemes, and book building, methods of stock issues. All these things are initiated in the period is 1990 to 22. And one important point in this period is the book building methods of stock issues became popularized in this period because it helps both investors and issuing companies. And in the same period, the foreign institutional investors are allowed to enter in the Indian capital market. Maybe FII and FDI contribution is also introduced in this period. So our financial, the emergence and development of finance, there is a three phases. First phase is the initial phase, that is merchant banking era. The second phase is investment companies era. The third phase is modern services era. The next have a simple meaning about financial services. What is a financial services? That is, the term financial simply refers to two concepts. One is mobilization of funds, and another one is allocation of savings. Mobilizing and allocating of savings. There is a three parties: savers, needers. There is an intermediary is coming forward for collecting the saving amounts in the form of investment. So it is identified as all those activities involved in the financial services, the process of converting saving into investment. It's converting your saving into a productive purpose. And also these services are designed to help not only for the businessman but also for individuals, businessmen, and the government in various aspects of managing their finances. The financing services also includes financial intermediaries. The financial services also includes the intermediary function also, such as merchant banking functions, venture capitalists, commercial banks, and insurance companies, etc. The major characteristics of financial services is service provider and user act as intermediaries, procure public funds smoothly. Services are based on customers' needs, dynamic and convincing services. The first one is the service provider and the user. The user means individual or maybe firm, companies, all these are involved in the process of financial services, and the financial institutions or is acting as an intermediaries in the flow of funds, that is savers to investments. And the corporate sectors procure public funds smoothly and within the required time with the help of financial service sector. And mainly these service is mainly providing on the needs of the customers. And major importance is there is a contemporary era changes is happening in our financial Indian financial system, so there are constantly dynamic and convincing services as emergence in our financial system. Next is the functions of financial service institutions. The first function is efficient deployment of funds. They help the firms or corporate not only for procurement of fund but also for how these funds are effectively used by the corporate. It's also guided by these financial sector industries. That is a two important functions in our financial management. One is procurement of fund, that is mobilization of funds. Another one is the how to use these funds in a productive manner, that is efficiently, effectively use these funds. So these financial service institutions help the firms or corporates not only for guiding or countering or provide mobilization of funds, and also it also providing an information or guidance to the corporate for how to use these funds, that is effectively and efficiently use these funds. And also these financial sector institution helps to construct the capital structure of the company. Capital structure means there is a mix of debt and equity. For example, your capital structure is 100%. How much debt to fund you are used? Normally equity, preference, debt. There is three source of funds is there in a corporate: debt to fund, equity, that is ownership. Equity means ownership capital. Preference is also coming under equity, and debt to portion. How much fund the company is holding for equity and how much fund is holding for debt to fund. This construction is helpful by the financial service. Maybe most of the merchant banking is coming forward to help the corporate how to fix the corporate structure, that is there is capital structure mix of debt and equity. For example, 60% equity, 40% debt, or 50% 50%, or 70% 30%, is depending upon the company's expected rate of return, that is EPS, that is earning per share. So these merchant bankers or the intermediaries are helpful to the companies for mixing or fix the capital structure, that is mix of debt and equity. The next factoring and fighting function is also done by persons are involved. One is supplier, other one is customer. The intermediary or the same things like exporters, importers. There is an agent for banking sector is an intermediary function for collecting debt on behalf of the his customers, that is supplier, that is company. Or next one is the traditional services and contemporary services. Normally there is a two types of functions done by merchant banker. One is traditional services. Traditional services normally means receiving deposit and lending, like financing, bill discounting, all these things. In case of contemporary, that is the modern services like e-commerce, securitizations, credit rating, securitizations, all these things. There is a number of modern functions. Is like insurance function is also is taken. That is so the both types of service intermediaries like banks or any other financial institutions like public pre and post pre-issue and post-issue and what is the par value issue and discount or premium, all the guidance is given by merchant bankers. And finally, that is specialized services like credit rating, capital, pulling of small sum of amount from this small investor, and this is invested to this stock market and the contemporary services. Some specialized services carried out by the mentioned bankers like credit rating, venture capital, mutual fund, depositories, credit card, housing finance, all these things is also created. So these are the major functions of financial service sectors. And the next topic is importance of financial services. The next topic is importance of financial services. The major importance are highlighted here. Importance of financial services. The first one is the economic growth, promotion of savings, capital formation, creation of employment opportunities, contributions to gross domestic, and provisions of liquidity. The successful functionings of any financial system is depend on the range of financial services offered by financial service organizations. The main important functions are here is the first one is the economic growth and development. The financial service industries mobilize the savings from the people or public and channelize them into productive investment by providing various services to the public in general and also corporate enterprises in particular. In short, he simply explained about the meaning of economic growth. I mean, the economic growth of any country is depend upon these savings and investment. The saving is converted in the form of the productive investment. That is only for the capital formation. That is the first point. These finances is very very useful for our economic growth and development. The second one is the promotion of savings. The financial service industries mobilize the savings of the people by providing transformation services to the industrial sectors. It provides liabilities, asset, and size transformation services by providing huge loan from small deposits collected from the large number of people. There is a small large number of people having small sum of amount. The amount is collected by the financial institution and invested in the huge investment project. So in this way, the financial service industries promote saving habit to the general public. Next one is the capital formation. The financial service industries facilitate capital formation by rendering various capital market intermediary services. Like capital formation is very very important for booming our economy. It's a very basis for our economic growth. The next one is the creation of employment opportunities. These financial service industries create and provide employment opportunities to millions of people are older. There is a lot of opportunities available in the field of financial sectors like insurance, mutual fund, credit rating, factoring, and forfeiting services, leasing. So there is now including marketing activities like investment companies, stock market operations. So there is number of employment opportunities created by the financial services, providing employment opportunities millions of people in India. And one of the major important contributions to GNP, that is gross national product. Recently, a survey by the contribution of financial services sectors in our gross national product has been increasing year after year. Maybe in normally there is a developed countries is only there is now there is more number of contribution for service sector in gross national product, but nowadays our developing countries is also the contribution is very high, has been increasing year after year. And final important is provision of liquidity. The financial service industries promote liquidities in the financial system by allocating and reallocating savings and collecting and investing the form of capital formation in various avenues, that is various investment avenues for our economical activity. It facilitates easy conversion of our financial asset into liquid cash. So these are the major important points, that is important services of financial sectors. First one is the economic growth, and the second one is providing of risk, third one is capital formation, and fourth one is creation of employment opportunities and contributions to gross national product and provision of liquidities. The next topic is types of financial services. The financial service industries render a variety, that is a wide variety of services to meet the requirement of individual users. The major services are listed here, that is a provision of fund, like a provision of a creation of funds in the form of venture capital services, banking services, asset financing, trade financing, maybe credit card, factoring and forfeiting. And the second one is the managing investable fund. These funds are collected by the small firm, and also guidance to the corporate how these use these funds. This is very helpful by the finance sector, like a portfolio management, diversification of your funds, merchant banking. There is number of mutual fund schemes are introduced. The invisible funds are introduced. Maybe pension plan is also is there. So this is way the financial sector is operating, managing investable funds and the risk financing. That is the project preparatory services, insurance, export credit guarantees is also given by the merchant banking services, and also consultancy services to the corporate sectors. And it is like a preparation of project preparatory services, project report preparation. For as you are an entrepreneur, you have an ideas, but you have no idea about how to prepare the project report. These services also done by the our financial services, merchant bankers is also there. Sometimes project appraisal, find out the where that is our positive return risk and return is also carried out by the merchant banker for appraisal system, which method is very benefit for the concern. Maybe there is number of capital appraisal method is there, maybe traditional method is there, modern method is there. These merchant banker is consulting to the corporate sectors how to use these funds, and how to increase the return on investment using which method is adopted, that is best for maybe in case of net present value method or internal rate of method. In case of traditional method, there is number of methods, is that payback method, ARR, a discounting method. So these consultancy services providing guidance to the companies for a project appraisal and project preparation, revalidation services, advisory services. Sometimes it's also find out the return on investment, is a real return or nominal return, what is your expected returns. All these functions giving guidance to the corporate sectors. Sometimes it is very useful for merger, acquisition, or the re-engineering purpose. All these services also done by merchant banking services. The next one is the market operations, like a stock market operation, guidance to the stock market operations, giving advice to the consultancies, providing depending upon the market situation, market is a volatile, how to move on this market, giving guidance. And money market operation, not only for capital market, money market, asset management, and how to register the companies. Maybe that's a is guidance to the solicitor function is also done by the trusteeship, how to prepare the trusteeship, retail market operation. Maybe there is a new emergent services like derivatives, like options, futures. All this guidance is given by financial service intermediaries. And nowadays there is a low research activities in the field of equity market operations or the financial sector. There is a lack of research. The service sector is also providing fund to the researchers to enhance the research and development like equity market operation, investor education, guidance. There is number of programs is created by SEBI for guiding the investor protections. Maybe there is a lot of scams is arised. So how to save the investors for this investment, and a training program is conducted by the agents like insurance, mutual fund, maybe share stock market operation is also, and also providing financial information provided to the general public needers, maybe agents, all these things. So these are the major types of financial services done by the financial service industries, that is provisions of fund, managing invisible funds, risk financing, consultancy services, guidance to the market operations, and the development of the research and development. The next is the constituent of financial services. There is a four major constituent in our financial services. The first one is the financial instrument. The second one is the market players. The third one is the specialized institution, and the fourth one is the regulatory bodies. The financial instrument in the first one is the financial instrument. The financial instrument in the Indian finance system may be categorized into two. One is money market instrument. Another one is the capital market instrument. The money market instrument means these instruments deals in a short-term nature. That is, the maturity period usually varies between a 14 to 361. That is within the period of one financial year. Any instrument you have to deal within the period of one financial period. That is one accounting period, like a short 1 year period. That is 12 months. That is called the short-term securities. That is the maturity period is normally between 14 to 364. That is number of money market instruments are like treasury bills, bill of exchange, or trade bills, promissory notes, commercial papers, certificate of deposit. All these instruments are deal in money market. These instruments are short-term instrument. These instruments are short-term securities. And the capital market financial instrument is comprising two instruments: money market instrument, and another one is a capital market instrument. Capital market instrument is deal in long-term natures like equity shares, preference shares, debentures. Debentures means creditorships. That is debt instrument. Equity shares, you know very well that is a owner's capital. That is equity share. Preference share, the preference shareholder is eligible for the preferential dividend. In case of the company getting profit, the who is eligible first means preference shareholder is eligible for getting dividend. At the same thing, like at the time of wounding up of the company, the preference shareholder eligible to getting its fund. But the equity shareholder is the real owner of the companies. So he is having the risk and the return is faced by the companies, but he is only having the voting rights in the annual general meeting, maybe special resolution or ordinary resolution. Equity shareholder, that is the owner, is only eligible for getting a voting in the AGM meeting. But in case of shareholder, the next is loan from banks, financial institutions, term loans, or all these things. That is a debenture. Debenture is a fixed charges. Another capital market instrument is gilt security, that is government securities. And the new modern securities arise in our capital market is derivatives, options, futures, all these things. So the financial instruments normally to money market instrument. Money market instrument means short term. Capital market means long term. Money market instrument, like the period is normally ranges from 14 to 364 days, like treasury bills, commercial paper, promissory note, all these things, certificate of deposits. In case of capital market instrument means shares in the form of equity, preference, debentures, government securities, bonds, and derivative securities like future options. All these things are coming under financial instrument. The major player in our financial services is commercial bank. Commercial bank is one of the major players, especially in India. These players major policy by commercial bank. Are the financing companies, financial market services intermediaries, and some specialized institutions are also engaged in the financial service sector in India. Like these specialized institutions are providing financial services in various forms, such as acceptance houses, discount houses, factoring services, credit rating agencies, venture capitals. All this is depending upon our needs. That is our changing dynamic environment. There is an emergence of these specialized institutions. This financial market is normally a dynamic. It's not a stable. It's a dynamic, changing nature, and solve the contemporary issues of corporate sector through the specialized service providers or emergence. And finally, there is most important point is regulatory bodies. Normally in India, the regulatory body is controlling authority of our financial system. Two major authorities in India. One is the Reserve Bank of India, and another one is Security Exchange Board of India. The functions of SEBIs are regulated body of the Indian monetary system. Two important regulatory bodies in India. One is Reserve Bank of India, another one is SEBI, Security. The they are the statutory bodies who have power for monitoring and also regulating the entire financial systems in India. So the regulatory body, there is two important bodies. One is Reserve Bank of India, another one is SEBI. This function is monitoring, not only for monitoring, regulating guidelines given to the stock market operation. Reserve Bank of India is giving guidelines to banking operational activities, banking and non-banking financial services. So these are the major constituent of financial services in the financial instruments, market players, specialized instruments, and regulatory bodies. And the next one is the scope of financial services. The financial services cover a wide range of activities. They can be broadly classified into two parts, namely traditional activities and modern activities. So there is two types of activities underwent in our financial service sectors. There is a fund based and a free based activities. In case of traditional activities, there is two types of activities are underwent. One is fund based activities and another one is non fund based activities. Two activities is underwritten by traditional activities. Fund based activity means underwriting of shares, debentures, dealing in foreign exchange market, that is a export and import rate, that is exchange rate means transaction between two currencies, that is rupees to dollar, all these things. So dealing in foreign exchange market activities, leasing, financing, hire purchase, venture capital, factoring and forfeiting. Next one is housing finance, insurance, and dealing in secondary market, that is stock market, dealing in BSC and the NSC, participating in money market instrument like treasury bills, discounting commercial papers. So this is a fund-based activities. Traditional activities, there is two types. One is fund-based activities, another one is non-fund-based activities. In case of fund-based activities, underwriting, foreign exchange, stock market, leasing, housing finance, all this is coming under fund-based activities. Non-fund based activities means the management of capital issue, that is issue of shares, pre and post issue management, that is non-fund based activities is underwritten by the financial service sector. Next one is the in case of traditional activities, non-fund based activities means arrangement for the placement of capital, debt instrument with investment banking, arrangement of funds from financial institution, maybe working capital, short-term financing, current asset and arrangement of working capital for clients like the current asset and the current liability management. Current asset and current liability management means current asset means the usage of funds within the period of 1 year, like cash, bank, marketable securities, sundry debtors, bills, receivables, inventories. This management is also guidance by the non-fund based activities. And finally, assisting in the process of obtaining government clearance. There is two types of traditional activities: fund based activities and non fund based activities. The next one is the modern activities. It includes rendering project advisory services, right from the preparation of project report till the raising of funds from starting the project. There is a guidance to the preparation of project appraisal and project report preparation. These are the functions, the modern activities. Planning for merger and acquisition, maybe giving assistance to the companies for merger and acquisition activities, and directing a corporate customers in capital restructuring purpose, acting as trustees to the debenture holders, recommendation suitable chances for management structures, and portfolio management, that is diversification of your fund by large public sector under the capital market services, clearing services, registration and transfer, transfer, and income securities. All these things is done by modern services. So there is two important services: traditional activities, and modern activities. We have to discuss one by one in deep detailed fund based and fee based services. The first one is the fund based. There is two types of services: fund based, another one is fee based services. First we have discussed about fund based services. The first one is leasing. Leasing is simple like a contract between a two person. One is owner of the asset, another one is the beneficiary who is need for these assets. The owner of the asset is called as lessor. The lessor means the person who is the owner of the asset. That is ownership and possession in hands of the person. The person's name is a owner, is otherwise called as lessor. The beneficiary name is lessee. So in case of leasing, two persons are involved. One person is a lessor, that is owner of the asset. Another person is a beneficiary. The person name is lessee. The lessee has the right to possess and use of the asset on payment of the specified rental over a predetermined period of time. So there is an agreement between two person, owner, beneficiary. Owner is given access to the lessee. The lessee has used the assets on the payment of some specified rental amount given to the owner for the predetermined period of time. Normally, the leasing, there is a three types of leasing: is there financial leasing, operating leasing, sales and lease back. Maybe one more is also included: cross border lease. Nowadays, there is very famous for a cross border lease. In case of financial lease, is one of the important leasing systems provided in our Indian economy. That is, the financial lease is an alternative to borrowing money and buying the equipment. That is, the machinery is selected by the supplier by lease based on its requirement. There is an agreement between two. There is an agreement is prepared. The agreement name is lease lessor agreement on usage of this asset. That is a financial lease, but ownership in the hands of the owner. Ownership is not divert to the lessees. There is a rental agreement between the lessor bear the risk of obsolescence and the responsibility of maintenance of assets. And a new method is also introduced: sales, sale and leaseback method. Maybe now there is emergence of a cross-border lease. That is, a cross-border lease means the lease agreement is made between the persons of two countries. Lessor and lessees are domiciled in two different countries. The lease is said to be the cross-border lease. So the leasing is one of the fund-based services. There is a different kinds of leases there: financial lease, operating lease, sales and lease back, cross-border lease, etc. The second fund-based activity is the merchant banking services. Merchant banking services is simple, like not only for doing the banking services, other services is also engaged by bank also, or some private institution is also. So simply refers to merchant banking refers to a range of financial services provided by merchant bank, which are financial institutions that offer some specialized services beyond traditional banking. Not only for doing the functions of traditional banking system, the bank is also doing some other functions also, like corporate finance, investment management. Corporate finance means normally there is a three types of decisions taken by corporate: investment decision, financial decisions, and dividend decision. These bankers, that is the merchant banker, help the companies. They help to the financial managers for fixing the decision. The value of whom is a function of three major decisions: investment decision, financial decision, and dividend. And these merchant banking is also used for investment management, maybe buying and selling of securities, and portfolio management is also giving advice to the corporate for pre and post issue functions. So today, the role of merchant bank in the capital market is significant, as it involves facilitating capital formation, that is procurement of funds from small savers and invested into big corporates, investment and financial strategy for business bank. So not only for the banking function, some other functions is also done by the merchant banking. The third function is the mutual fund. A mutual fund means the pooling of the investment by the number of investors by way of investing in units in equal size. This is one of the intermediary function is done by mutual fund industries. It helps the small investors participate in the security market. A small sum of amount is pooling by an mutual fund agent that is invested to the security market. The returns is divided into net asset value. So the purpose of mutual fund is to help small investor is also participated in the security market indirectly, but with reduced risk for small investors by diversifying the investment into various types of securities of different corporate and industrial activities. The next one is the credit rating. The credit rating is simple like an find out the credit worthiness of the borrower. Simply is an assessment of the credit worthiness of the borrowers, whether it's a government or corporate or individual. The credit rating agencies assign credit rating based on the evolution of the entity ability to meet his financial obligation. The ratings are maybe there is a letter is the triple A, double A, triple B, etc. I mean, it's an expert opinion by rating the agencies on debt instrument. These agencies evaluates the repaying capacity of the issuer of such instrument. The rating are denoted by a symbol triple A, that is AAA, is highly secured. BB means moderate, C means high risk, and D means default. So this is a rating agency very helpful for the expert opinion by rating on debt instrument. And the next one is the venture capital. It's nothing but a is a form of private equity financing provided to. There is number of stages for your project appraisal, that is early stage, high potential and growth companies with the expectation generating a significant return on investments. And venture capital play a crucial role for innovation and supporting for entrepreneurship, and also providing an innovative ideas is also given to the entrepreneurs and driving economic growth. Very useful. It involves a successful completion of the entrepreneur for his project at the time the need for the capital, that is the seed capital, that is provided by the venture capital. The next one services is the factoring services. Factoring services means is a fund based services. It is defined as the relationship between two person, maybe one is a banker, another one is a business concern. The selling goods or providing service on credit, whereby that is simply factoring means collection of debt from the customers, maybe bank or anything. These functions is involved for there is number of new methods that we are discussing in detail for these factoring services. Next, there is an emerging finance. That is a emerging finance. So there is a new concept introduced in our financial Indian financial system. That is financial engineering. That is financial engineering is the lifeblood of any financial ability. Simply explain about the financial engineering means financial engineering is the design, the development, and the implementation of innovative financial instrument and process, and the formulating of creative solutions to the problems in finance. These financial engineers play a vital role in modern financial landscape, contributing to the development of the innovative finance, that is introduction of innovative financial product, risk management strategies, and giving, and also encourage of the research for advanced quantitative models. That is quantitative models are introduced in the field of finance using statistical techniques tools or econometric technique tool. How these tools are used for predict our equity market, for predict our new issue market, at the which time is best for introducing for IPO, initial public offering. Simply introduction of new financial instrument, and same time how to avoid the risk with the help of using quantitative techniques in the field of finance. That is a major function by financial engineering. And next one is the development in this sector. In the last 2 decades, there is lot of changes taken place in our financial service. Some important factors are displayed here. The first one is the financial sector reform. The financial sector reform means LPG, that is liberalization, privatization, and globalization for reducing and eradicating the deformation in financial market and reinforcing financial. There is in the emergence, there is a new emerging contemporary existence after there is a stabilization introduction of these policies. So this is a major developer in this sector for financial sector reforms. The second one is the technological development. The scenario of global financial system. Maybe we are using nowadays before introduction of the internet and access facilities, we go for investment in the share market. We opted for the stock brokers, approach the stock brokers of the once the instruction by the stock brokers, we have to invest our money. But nowadays we have facilities for access the market. We have opened an account with one brokers like Angel One Pro or something. We have directly invest to the market. We are not need any help for any other. So this is a way there is an access facilities is available for entering in our financial systems. Today we are interested for mutual fund. We are directly investor. No one need help for that. And we are interested for investment in Bombay Stock Exchange. Just you open the Demat account and you are directly open. So there is an emergence of the technological advancement, technological development, especially the facilities available for internet facilities is very helpful for the investor. Maybe a small investor is also directly investable without the helping of the intermediary. So this is very useful for the technological innovation is very useful for the investors to directly enter to the market without help of any needs. And the next one is the consolidation. The consolidation means the leading financial service firms are increasing in size due to merger. There is a today there is a merger for maybe before 1992 the activities of merger acquisition, maybe one or two companies are opted for the strategic alliance. But nowadays we go for merger acquisition, restructuring, capital restructuring. All these things is happened in very easy way. So very consolidation factor for the contemporary world. Next one is the globalization of financial services. Financial institutions are entering into the internet and next one is the changing role of financial service providing. In the contemporary world, national banks are doing fee-based and fund-based services. Before that, only banking function is done by banking, but after the LPG, the bank is also doing the functions of merchant banking, that is pre and post services. And the mutual fund agents are coming forward. Insurance business are existence very more, and venture capital financing, housing financing, maybe higher purchase, leasing, all these things are emergence in the field of the contemporary world. So the changing before the financial is only for banking function. Nowadays, not only for the banking function, other function is also carried out by the banking sector is also banking sector and the non-banking sectors like issues, portfolio management, say valuation of securities, and a project appraisal. Maybe a hurdle rate is also fixed by the banks like cost of capitals, leverage functions, working capital functions, dividend policies, guidance, all these things is given by the there is the emerging situations and competitions and outsourcing or persons to do particular functions. Maybe is a cross-border activities is also done in our financial sector. These are the major development in the financial sector. That is financial sector reforms, technological development, consolidation, maybe introduction of modern identification, consolidation, number of challenges there. I have to highlight only some important challenges in our financial sector. One is volatility of market, increasing customer expectations, lack of technical knowledge, lack of professionalism, deficiency in performance appraisal, concentration of wealth, on account of malpractices, scams, the lack of safety, deficiency in marketing process. The first one is the volatility of the market. Yes, the market nowadays the market is maybe past 1 month. Our market, that is the Sensex, is down by more than 900 points. Nifty is also there. So the market, we are not predicted market. Market is uncertain, may or may not. There is a lot of risky factor is available. So these are major challenges by the companies, investors, maybe general public is also. So market isn't volatile, but it's not in a stable. It's volatile depending upon the uncertainty. Factors maybe war, terrorism, maybe sometimes US election is also impact our Indian market. FIIs are get back the fund and invested to China market. So these are the market is not in a stable nation, and also it is not easy for the investor to predict the market. Tomorrow market is positive, it is not possible. Maybe it's uncertain and it is increasing. So you have to, before going to go for any investment, there is a lot of challenges. First, you have to learn about what is the risk factors available for this investment avenues. After that, you go for the market. So volatility of the market is one of the major challenges faced by the financial service sectors, and also increasing customers' expectation. Now, nowadays, customers' expectation is very high. We are not opted for only for the division method. So there is a lack of technological knowledge is also there is a major challenges faced by the maybe technological advancement is also very lack of professionalism that is care about the job. Sometimes mutual fund, you know, invest in mutual, having market risk. Sometimes there is a wrong decision is taken by the mutual fund in the mutual fund sector. It's also affected the NAV of the customer. Sometimes there is lack of professionalism, maybe deficiency in performance appraisals, maybe most of the time the invest that is the corporate sector is concentration on the wealth. So they are using some more practices and scams is increasing. Maybe you know very well the wrong cases, especially on the financial service sector, and also lack of safety. There is a risk, there is a return. In our investment, our Indian financial system or SEBI or Reserve Bank of India take a lot of measures for monitoring and securing investors. But whatever measures is taken, the safety is very, very less in the field of Indian financial system. This is also one of the challenges faced by the finance sector, and a deficiency in the market process. So definitely, there is no proper MIS systems is available in our financial systems. So these are the major challenges faced by the challenges in the financial sector services. Financial services. The first unit today we have discussed about the introductions about the financial service industry, its classification. There is two intermediaries: capital market intermediaries, money market. Capital market means long term, money market. Bodies. One is Reserve Bank of India, another one is uh, Security of India. And the scope there is traditional. Thank you.
Voice is audible, ma?
Yes, sir.
Okay, ma'am. Thank you. Just wait for a few minutes. It's a visible, ma? Notes is visible?
Yes, sir.
Okay, ma'am. Okay, ma'am. Morning we discuss on the types of bank based on structures, ownership, and functions. So, functions, the types of banks based on the structures, based on the ownership, based on the functions. Based on the structures, you can expect this question from 10 marks, banking systems, or explain the various types of banks based on structures, ownership, and function. Two questions you can expect from an examination, 10 marks examination. You to write this flowchart is enough. Along with this flowchart, you can explain your own sentence. No need to go for books to read everything. Unit bank. Unit bank means unit bank, branch banking, group banking, chain banking, followed by correspondent bankings. This is based on structures, bank structures, and based on ownerships. You know that ownership, public bank, private bank, and foreign bank, and cooperative bank. Public bank means public. Government will ownership of the banks. Private bank, private sector people were ownership of this bank, foreign companies, foreign institutions were ownership of bank, cooperative bank, both people join together, public and mm, private, and also based on the functions. Savings banks, savings bank, commercial banks, based on the business, commercial banks, industrial banks. Industrial means based on the industrial, the lending loan to the industries, like it should be Small Scale Industry Development Bank of India, IDBI, Industrial Development Bank of India, Agricultural, NABARD, National Agricultural Development Bank of India, investment bank and investment bank and for Exim Bank, then cooperative bank. So just now before we discuss on cooperative bank, based on development of rural area and based on the industries, they'll start a cooperative bank, cooperative society. Along with that, you start a cooperative bank. Then regional rural bank. Bank itself, they are running the regional rural banks, RRBs, development of rural banks, because they will not reach the rural people. It's quite difficult to reach the rural people. For that purpose, Indian Bank itself, they start the Grama Bank. Many banks were started as Grama Bank in rural area, that is called as Regional Rural Bank, RRB. Then Exchange Bank. Exchange Bank means foreign exchange transaction, Exim and export and import transaction. For the purpose, they were started Exchange Bank, that is Exim Bank, export import banks. Indigenous banks based on Consumer Bank and Central Bank. We'll discuss one by one. based on structures. Unit bank means a type of bank under which banking operation carried by single branch. That is very, very important. Unit means what? Unit means single. That's why the type of operation they were running the branch within the limited area, that is called as unit bank. Normally, these banking systems originated from America. Then branch banking. Branch banking, you know that very well. So type of banking system under which banking operation carried out with a branch network. Branch is controlled by head office. That is called as branch banking. Head office somewhere. They control, they have separate branch. Suppose Tamil Nadu is head office means throughout India they have branches. Bank of Baroda, Syndicate Bank, followed by Bank of Punjab, Punjab National Bank. They have separate bank. Now their banks are merged together based on business operation. Present government, all the banks were merged together. Indian Bank and Canara Bank, followed by merged together. So the office branch, head office somewhere, but they are running the branch all over India. That is called as branch banking. And group banking, already we discussed group banking. Holding the company, subsidiary companies carried out banking business. That's group banking. SBI subsidies, all 7 subsidies coming under group banking. That is called as group bank. Chain bank. Chain banks, different banks come under common control through common shareholders. That is called as chain bank. Different banks, but shareholders is common shareholders. The share of the bank shareholders is common shareholders, but they were running different banks. That is called as locking same directors. Suppose you take it as an example of India, Karur Vysya Bank, Lakshmilas Bank. Different banks, but owner shareholders, common shareholders of the both banks, Lakshmilas Bank and Karur Vysya banks. It's a located office is Karur, but presently the Karur Vysya banks and we be take over by somebody. Karur Vysya Bank separately they were running. I am told about previous 10 years before. Both banks were called as chain bank, different bank, but shareholders of the banks were common. Owner of the banks were common. That is called chain bank. Then correspondent bank. Correspondent bank means many Indian bank act as a correspondent bank and many foreign banks. Link two banks in different statutes or size. Correspondent bank is which link two banks of different statutes of size. Present days, they were running like as a correspondent bank, like Indian Bank and Canara Bank. So we are running correspondent banks. Merged together. Based on ownership, already we discussed on ownership, based on public sector, private sector, and foreign banks and cooperative banks. Public banks, you know, may very well 50% or 51% shareholders by public, like government of India, and 49% shareholders holding by private people, like you, like me and you. That is called as public sector banks. 2% of share higher than the private people. Then private bank. Private banks singly run by the private people. The owners of the banks, private shareholders. That is called as private sector banks. Then foreign banks. Foreign banks, the countries have the head office is somewhere like USA or UK and followed by Australia and China. The bank head office was somewhere where they were running the business in India. So that is called foreign banks. Head office somewhere, but running a branch in other countries. That is called as foreign banks. Suppose you take the example of Standard Chartered Bank from USA, but they were running the business in India. Only I think Standard Chartered Bank and Citibanks were more client in India, like foreign banks. Other foreign banks have only less client, but Citibanks and followed by Standard Chartered Bank having more Indian clients that they are having. Cooperative banks, running by the foreign cooperative banks, only service motive. This motive is not profit making, to help the weakest section of the society. Cooperative banks include central cooperative banks and state cooperative banks, both together. That the employee along with the government also both were combined together running the cooperative banks, not a profitable manner. To uplift the weakest section of people, that's the main aim of water. cooperative bank. The main motto is all the people will get the benefit from the cooperative bank, cooperative society. And based on the function, what are the functions? Savings bank, you know that very well about savings bank. CASA, current account, savings account. The main aim of the government is what? To increase the financial services to the all set of people, not only weaker section of people or middle class people or elite people, top class people. All the people having financial service means definitely they increase the awareness program among the financial awareness program among the people to increase the savings banks, increase the savings bank. That is a motto of government, because people does not hold the money in home. The money does not have value. That's the main objectives. All the money pulled by the government, they circulate the money in the economy. That's very, very important. That's why we always approach savings account. Any form of savings, like insurance, like deposits, or a current account, savings account, or many way, retirement pensions account, and for many way they invest money in securities or insurance or pension schemes or whatever, because we pull the money from the public. We collecting the mobilizing money from the public into money circulation. Money circulation is the blood of the economy. Money circulation inflows the blood of the economy. Money does not keep it at hold in home that don't have value. That's why Government of India, to encourage the people to come over to invest money in savings account. Then commercial banking activities, you know that commercial banking based on business purpose. Accept the deposit for the lending purpose. The main aim is to credit money to the lending money to the business people. Based on that, they are generating revenue from the bank side, because the loan is asset of the bank. The deposit is a liability of the bank. So the main aim is what? To provide many services to the customer, like short-term loan, business loan, cash OD for business, cash credit, and excess of services provided by the banks. Apart from lending, there are many services. There are many services like check collection, discounting bill of exchange, facilitating money transfer, etc. Then industrial banks. So industrial banks, already told very clearly, IDBI, Industrial Development Bank of India. Small scale industry want to develop means small scale industry lending money to the small scale business people, MSME people, medium and small size enterprises. For that purpose, they started an industrial bank, IDBI, Industrial Development Bank of India, small scale industry development, SIDBI, Small Scale Development Bank of India, and followed by other banks. They were separately, they formed separate banks for business purpose only, industry purpose, development of industry purpose, development of infrastructure purpose, development of other sector get benefited from these industrial banks, because India still we are backlog in industrial reforms in India. Still we are our service sector is the most performing sector in India compared to other sector, industry sector, agriculture sector, paramedical industries, followed by other industries were there in India. So for that purpose, separately, the particular industry sector want to develop and creating more employment opportunity. To that, they were directly contributed to GDP. Standard of living were increases. Health and education followed by all should be increases. They are developed industrial banks. Those are provide long-term loans for industry purpose expansions. If you want to expand your company or modernize your company based on the current market situation, for that purpose, they are lending loan to the long-term loan to the business. Once you can lend money to the corporate we are doing business, expanding the business. We can't predict they are expanding the business. Not only they were doing same business, they were doing different business. So again, the same banks were lending loan to the different business. Bank also keep maintaining the long-term relationship with that corporate sector. Corporate also maintaining the long-term relationship with the bank. Banks also enjoy the benefit. Corporate also enjoying the benefit, lending loan to the industries. So money circulation also, inflow outflow will be always be there. It will be there in both the corporate as well as banks. Sorry, company as well as banks. For that purpose, they started industrial banks. These banks are also responsible for backward areas. Suppose you can travel along with Kadalur, special economic zone there. SIPCAR is there, and followed by all the Tamil Nadu area, some industrial estate, India, particularly in Pondicherry, you can go to Metupalayam and followed by Kadirigamam and followed by Siadarapet districts and Tirubone area and the Pathakani area, many in Pathakana and followed by that Villanur area, many industrial estates were there. Many industrial estates were there. So for that industrial estate, bank were lending loan to the development of backward area, to generate more employment based on banks. They're lending money to that small industry. They were they were started a small industry. Along the small industry, nearby local people, local people generating employment opportunity to the local people. Based on the local people, local revenue were included. They also contribute to our GDP. For that purpose, this is a cyclic process. For that purpose, they started industrial banks and investment banks. Investment bank, you may know very well about investment banks. Banks not only running their business, only lending the loan, accepting deposit, and also they are taking more risk. They were lending money to export, import. They were collecting the deposit, not only lending money to the corporate business or export, import, and followed by other business. They also taking higher risk, higher return, lower risk, lower return, medium risk, medium return. Trade off between risk and return. That is the main job of bank. Trade off between risk and return. They were invest their customer money, deposit money into stock market. They invest money into debentures market. They invest money into commodity market. They invest money into currency market. And also they not only invest money in India, and also they having huge opportunity at the global level. They were investing money in the other country also, like purchasing share and debentures, and followed by their short-term money market, long-term money market, treasury bill, followed by other bond were buying from the banks. That is called as investment bank, because investment banker act like a portfolio manager. They were not taking a risk from the one sector. They were diversify the risk. Suppose in your hand 100 rupees, you can invest your money 100 rupees. Buying the gold itself means we will never expect return from the gold. At least gold rate will be fall down means you lost your money. So 100 rupees you can diversify the sector. 20 rupees for gold, 20 rupees for stock market, 20 rupees for fixed deposit, 20 rupees for real estate, and 20 rupees for mutual funds. Suppose real estate not performed well, mutual fund will be performed. Mutual fund not performed well, real estate will be performed. Real estate not performed well, gold will perform. Gold will not perform well, deposit will perform. Deposit will not perform well, stock market will perform, because we can't predict the market. Market is always depend on the market. Market is forced by interest rate. Market is forced by risk and return between the customers. Market is forced by everything. Anything to happen in the global, that will directly impact on stock market. So that is called as investment bank. Banks itself, they were running a separate branch as an investment bank. That is called as treasury management, risk management, foreign exchange. So all the activity done by bankers. Then agriculture and land development bank. For agriculture sector, for particular agriculture development, they started NABARD bank. Then land development bank. Suppose their land, suppose you buying the land, real estate, that is called as land development banks. So for that purpose, they started land development banks. And agriculture for infrastructure purpose, they started land development banks, and agricultural development purpose, they started agricultural bank. Then cooperative bank, you know that cooperative bank under Cooperative Society Act 1912. Then regional rural banks, development of rural people, they started Regional Rural Bank Act 1976. Banks were established by government under Regional Rural Bank for small marginal farmers, agricultural laborers, artisans, small entrepreneurs in rural areas. Find out those people and lending money to those people. They will enjoy the benefit, and also their employment opportunity will be increased in the rural areas. Their asset were increased in rural areas, development of rural areas. They started regional rural bank because we all the banks were commercial banks, and for the foreign banks not interested to do a business in the rural area. Their main aim to the main objective to cover the people from metropolitan cities. Rural who care about rural areas. So only banks itself, commercial bank itself, public bank itself, they started regional rural bank in rural areas and cover the rural customer. The upliftment of rural people, upliftment of poor people, upliftment of below poverty line people, they started regional rural bank. And lending money, microcredit, that's very, very important, not a huge amount. Microcredit, micro loan lending to the rural people. One separate bank is microfinance. Take it as an example of microfinance. So development of rural area, they started regional rural bank. Then exchange banks. Exchange banks, you know that exchange banks, Indian banks, they were running the branches in outside countries. That is called exchange banks. Foreign exchange banks, they are incorporated outside the countries, but carry out business in India. That's the exchange bank. Suppose for UK banks, UK banks tie up with Indian banks. They were doing business, export import business. All the services on behalf of the UK bank, Indian bank were give service to the local customer. The same as to Indian bank tie up with UK bank. All the UK customers, Indian customers were the transaction purpose, any other purpose, on behalf of the Indian bank, UK bank provides service to the UK customer. That is called exchange banks. Then indigenous banks, money lenders, Shukras, you know that's in India, we are indigenous banks, many indigenous banks called as SET. In Tamil, we are saying indigenous bank, SET Kadai. That is a SET shop, SET financial shop, that is called as indigenous bank. Lenders, money lenders, they were lending money to the public. Some hold in their hand gold or their home, some asset they were holding. Along with that asset, they were lending loan to the customer. That is called as they were more popular in villages and small towns. Consumer bankers. It's only operated in developed countries like USA, Germany. Only operated in advanced countries. Customer purchase durables like car, TV, washing machine, furniture. That is called as consumer repay the loans in easy installment. That is called as consumer banks. Consumer banks in present days, Bajaj Finance and followed by other finance in India, they were running the banks like consumer banks. You need some durable products like car, TV, washing machine, furniture, etc. You approach Bajaj Finance, they were lending loan to the customer. That is called as consumer banks. Then central and federal and national banks. Central and federal and national banks, they were a leader of all the commercial banks and every country's central bank. They were leader of all the banks. They were monitoring all the banks. They were the monitoring authorities of all the banks. That is called a central bank. They were control the entire bank, private bank, public bank, foreign bank, RRB and cooperative society, all the bank controlled by central bank. That's why we call as central bank, federal bank, national bank. Their main aim is to control the money circulation, and their main aim is to interest rate fluctuation. They want to control the interest rate fluctuation. This is called the central bank activities. Then structures of Indian banking systems. What are the structures? Reserve Bank of India, there are two types of banks: scheduled banks and unscheduled banks. Scheduled banks and unscheduled banks. And also NBFC also you should be include to that scheduled banks, unscheduled banks. Scheduled banks means commercial banks. Commercially, they were running the business. Commercially, they were running the business like public sector bank, SBA and its associate. Everybody should know about SBA and associates. SBA and associate. National Bank by Canara Bank, Indian Bank, followed by Punjab National Bank. These are all coming under Nationalist Bank. Other public sector banks, other 50 public sector banks come under public sector banks coming under commercial banks. The Reserve Bank of India control the entire banking process, entire banking under all the banks under control of Reserve Bank of India. These are public sector banks. Then private sector bank, old generation bank, new generation bank. Old generation bank, if you take the example of City Union Bank and followed by Karur Vysya Bank, Tamil Nadu Mercantile Bank, and Lakshmi Vilas Bank. These all the banks are old generation bank. Previous, they were running their banks more than 100 years in India. That is called old generation banks. Within the private sector itself, I said old generation. Then new generation banks like Axis Bank, followed by ICICI Bank, and new private banks. Present days, what are the banking, the new banks they were running? That is coming under new generation banks. New generation banks implemented new technologies. Old generation banks also implemented technology. And then previous year they don't introduce new technology. After LPG, liberalization, privatization, globalization, they were introduced new technology, centralized banking, core banking solution, tie up with private companies, tie up with private IT companies, all the facilitated by private companies, all the data where all the data, information, everything is stored in private companies. So that is very, very important. This is old generation bank, then new generation bank, new generation banks, new every 6 months or every year there implement new models like bank-led model, non-bank-led model, correspondent model. Then correspondent model followed by new application banks along with UPay, repay, many things that is called as new generation banks, then foreign banks. Already told Standard Chartered Bank and City banks, foreign banks that is also running the business in India for commercial purpose only. Regional rural banks, we are separate from regional rural banks, separate from public sector, private sector, foreign banks. They are also running the banks for commercial purpose in rural area. That is very, very important. In previous banks were running the banking in metropolitan, semi-urban, urban area, but regional rural bank, they are also regional rural bank also running the bank for commercial purpose, but in rural area. That is called as commercial banking. Then unscheduled bank. This all should be coming as scheduled bank. Properly, they are registered under scheduled banks. Then unscheduled banks registered under RBI. Then cooperative banks also coming under scheduled banks. Cooperative banks, urban cooperative banks, and state cooperative banks. Based on that area, they were diversified that name of the banks. Urban means urban development, urban people development. They started urban cooperative banks. Then state cooperative for state purpose, state itself they want to develop the state. State itself they started state cooperative bank. Then unscheduled banks coming under NBFC, non-banking financial institutions. So Reserve Bank of India, you know that Reserve Bank of India, what are the 1935 Act, Reserve Bank of India coming under Company Act, Banking Act, the effect of 1935. And the main, it will guide the commercial bank and followed by other, it maintains a government record relating to revenue and expenditure under various head. It advises the government on the monetary and credit policy and decide on the interest rate applicable to the bank deposit and loan advance. Already told, the main aim is credit policies decide the interest rate applicable. That is very, very important. That's why they keep maintaining the SLR and the CRR, cash reserve ratio, statutory liquidity ratio, then all the variables, repo rate, reverse repo rate, to maintain the interest rate, repo rate and reverse repo rate, all should be relevant to the interest rate. That is monitored by the policy and decide everything done by RBI, and the money circulation, that is very, very important. Regulate and money circulation in the countries. Keep deposit of commercial banks. It provides financial accommodation to commercial banks. That is the main. It does not deal with the general public. It asks banker to government. It banker to government. Then Ombudsman Act is there, relevant to any customer related complaints. You can register under RBI, under Ombudsman Act. This all act done by the RBI. Then in Scheduled Commercial Banks, Scheduled Commercial Bank, Reserve Bank Act, 1934. It's come out 1934. After main aim is this main aim of scheduled banks. They were deposit and collecting. Accepting a deposit for the lending purpose. Accept a deposit for lend short-term loans or advance their customer. This is the main objectives of scheduled commercial banks. Then public sector banks also same process. Their main aims to lending, accepting deposit for lending purpose. State cooperative bank. Based on the year, you can see the year of the branches and act. Everything you will be always remember act, which act coming under State Bank of India, which act coming under RBI 1935, 1956. These are all the act in 1955. You have to always keep remember on this act. So Industrial Development Bank. So Industrial Development Bank is IDBI, India's largest commercial bank for over 40 years. Bank has a key nation building role because industrial development, any country is having more industrial development in the country that is called as a developed country, like US, China, and followed by European countries. Get the example of European countries. Major revolution were happen in the Europe countries and followed by America and China. Industrial development happened. India adopted LPG after 1993, but China were adopted LPG in 1970s. So major revolution were happened in China. Major industrial revolution were happened now. Entire global market occupied by China based on industrial development. Then private sector banks, national banks also coming under four private sector. Old private sector banks they converted into operating in India. They 1969 they were former Prime Minister Indira Gandhi announced as a nationalist banks. In fact, more new generation private bankers they also be there. More branches are available. After 1993, all the new branches were introduced in India. The license up to amount, how much amount you need to start a bank, 300 crores. No, 300 crores introduction in private sector bank in 1993. Foreign banks, those banks are registered under incorporated head office foreign country, but they have get the permit from RBI, Reserve Bank of India. They were running an operation, the banking services in India. Regional Rural Bank, 1975 Act, coming under 1975 Act, they were running the bank in the rural area, development of rural people. Scheduled Cooperative Bank main objective is not, they were running bank for profiting manner. The main aim is to backlog people, backlog area, and for other people who want to develop the purpose, please, they started Scheduled Cooperative Bank. Scheduled Cooperative Bank coming under NABARD, a lot of reforms were happened. NABARD were started. NABARD were insist all the state government followed by many industries were started. Cooperative banks, benefit of the local people. Then Urban Cooperative Bank, State Cooperative Development of State. This is the State Cooperative Bank, applies highest level cooperative banks in all states in India. State Cooperative Bank, because they attract more deposit, and also they collecting mobilizing deposit from rural area and urban area. That's called state cooperative banks, particularly urban area. They have running by state have stakeholder from the state cooperative bank. The non-scheduled banks, they are Non-scheduled banking means banking company as defined as the Section Act 1949, non-scheduled banks. Then banker and customer relationship, that is very, very important. Banker and customer relationship is very, very important. You can expect this question from only 5 marks. Suppose under marks question paper means 5 marks, 6 marks. 75 question, 75 means 4 marks, I think. Bankers and customer relationship is very, very important. So according to the Banking Regulation Act 1949, bank is defined as accepting the purpose of lending purpose or investment deposit money received from the public and repayable on demand. That's a very, very important. This line is very repayable on demand. We are not a position to command the customer. We repay the amount later, like we were told. Customer benefit is our benefit. Customer profit is our profit. So to repay money to the customer based on their demand. That's called as repayable on demand, on withdrawable by check, draft, order or otherwise. The banker is not defined. BR Act. Banking is a definition highlights 2 points. The primary functions of the banker, again and again the same things come, the same line will repeat. That's why I told you very clearly, you just look at the basics points of this banking system. It's a very huge theory was given in these books. You go very crispy point taken from that examination. That is enough. And you have year is very, very important. Act is very, very important. Year is very, very important before going for writing the exam. Accept deposit from the public, then grant loan and advances to the public, issues and pay checks, collect checks from the customer. This is the main functions of what a banker and the customer, and main relationship between the banker and the customer. And withdrawal and demand, that is repayable on demand, that is main functions, relationship between the customer and the bankers. So the main business where they're doing, customer and bankers are accepting the deposits from public and the grant loan and advances. That's very, very important. Grant loan and advances, issue and pay checks. Issue and pay checks. Issue the checks and pay the check for that money. And collecting the check for his customer. Definition of customer. In bank, the word customer has its origin from custom. So we don't want to discuss this. What is the main relationship for bankers? Existing customers, former customer for service like demand draft, purchase, check enhancement, etc. That is called as between relation between customers and banks. And also accounts relationships regarding bank account, savings account, and followed by current account relationship maintained by the banks. That's called as CASA, current account, savings account relationship maintained by banks and customers. Account relationship is a contractual relationship. Is generally believed that any individual or an organization which conduct banking transaction with a bank. Why we go for bank? We conduct a banking transaction with the bank, customer and the bank. This is the main relation between the banks and the customers. Customer, however, there are many persons who utilize the service of banks but do not maintain any account with the banks. That's many. Yeah, definitely. Many people were using service of the bank, go for DD, unfollow for other purpose, but they will not maintain the account in the bank. So therefore, bank customers can be conventionally classified into 4 types: existing customers, old customers, and former customers. Customers for like services like demand draft, check enhancement. Then potential customer, they have huge deposit in banks. They have done huge business with that bank. That's called as potential customers. And also Government of India introduced to reach all the people like financial services, they started no frill account. No frill account. That is also why to started this process in India. No frill account. All the people coming under financial inclusion. They don't have money. At least they utilize the financial services. At least they are enter into the bank, enter into the financial services. They enjoy the benefit of financial services. Enjoying the benefit of financial services. We pull the money from public. We mobilize money from the public. Then what are the way is there to reach the public, to mobilize money from the public? For that purpose, even 10 rupees transaction, 20 rupees transaction, 100 rupee transaction also be happen within the bank itself. That's why they started no frill account. The people fear about to open the account in banks. For that purpose, Government of India, particularly scheduled tribe and followed by that deprived people, deprived society of this country, they started like below poverty line people, many below poverty line people. India is not almost like a developed nation. We are developing nation. Still, we are a 127 nation. Our nation still 105 or 107 position hunger index. Now that you know of the real India hunger index, even that is 40 crores people don't have food in India. That's a true fact. For that purpose, at least every transaction done through banking, they started no frill account. We don't want to maintain the balance, minimum balance of that account in that bank. 0 price is enough. At least you enter into banking services. For that, this is the main aim to Government of India introduce this scheme. Then that scheme clearly they were mentioned customer. The KYC norms is very important. Know your customer. Know your customer. Previously, what will happen in 1990s before, their bank will lending loan to the customer, but they were giving fraud address, duplicate address. They're lending loan to the customer, they're enjoying the benefit, they are getting loan. After that loan, they are going somewhere, they migrate to somewhere. The bank will come under NPA, that money will not performed standard, substandard, and a non-performing asset. Standard asset, substandard asset, and followed by non-performing asset. The amount performed within 3 months, that is a standard asset. The amount will perform within the loan with the perform within 6 months, that's called as substandard asset. That same loan will not perform within a year, that is called as NPA, non-performing assets. For the purpose, we maintain know your customers, know your customer, know your customer. Present days, it's suppose you open the bank account, huge protection is there. Know your customer. Aadhaar card, PAN card, and followed by your address proof, gas, everything. All the proofs will be enclosed in banks. Then only they open the account. Previously, they are not following know your customer. In present days, know your customer is very important, because banks come under NPA, non-performing assets. Based on these confusions that happen in the banks, banks properly not maintain the customer information. 1990 before, because we are maintaining the customer information based on physical mode, books and followed by ledger and followed by other desk. These everything is only we followed. After LPG, we maintain all the information systems. Backup is enough. So know your customer is very important. Know your customer is very important. After computerization of all branches and interconnectivity, customer can operate their accounts from any branch of the bank from anywhere in India, anywhere of the global. After computerization of all the branches with interconnectivity, that is the earliest system of customer to branch converted into customer to a bank. Earlier system is customer to branch, and present system is customer to a bank. However, any specific claim of action, approach branch with the maintain the account. That is the relationship of banker and customer. Then general relationship and special relationship between the bankers and the customers. What is the general relationship? Debtor-creditor relationships. Debtor-creditor relationship. That means open the bank account, and also creditor open with a loan account. That is called as debtor-creditor relationship. Debtor means deposit. Your bank collecting or mobilizing deposit from the customer. That is a debtor. Creditor relationship. Bank are lending loan to the customer. There is a creditor relation between the debtor and creditor to the banks. Then creditor to debtors. That you know, the creditor to debtors again credit. Bank will credit loan to the customer, grant loan and advances. Grant loan and advances. They are the debtor. They repaying money to the what? Bank as a debtor, bank as a creditor, receiver as a debtor. They repay money to the banks. Debtor and creditor relationship means depositors to lending money to the banks. Banks will repay loan to the debtor. Here, bank will creditor, debtor will repay loan to the banks. Debtor means borrowed loan from the banks. Then special relationship means banks as a trustee, banks as a trustee, banks as a bailey, banks as a agent, banks as a custodian, banks as a principals of all the customers. Bank as a trustee means we depend on banks. Banks will give confidence to us, the customer. Don't bother about your money. We will take care of your money. We will repay in advance, repay in demand, repayable in demand. That's as the bank as a trustees. Gold loan and home loan. Whether you go for gold loan, home loan, deposited your valuable material in the bank. Based on that, bank will lending money to you. So they are trustees of your property, trustees of your valuable property. That's called a bank as a trustee. Then also banks will to maintain the account, maintain your account, savings account, deposits account, and NRI accounts. So bank as a trustees of the customers for savings account, deposits accounts, NRI accounts, all the accounts. Banker as a bailey, banker as a bailey. Bailer means banks where delivery of goods by one person to another for some purpose. That's called as banker as a bailey. Banker as a leaser, proper transfer of property act. Bank lease the leasing activity. Banks also operating leasing activities. The premium of rent. That's a bank as a leaser. Bank as a leaser. Such as a lease of immovable property or a transfer of right of enjoying such property. It made a certain time, like you go for loan, home loan. That's called as a leaser. Bank as an agent. Bank act like an agent. They will provide all the services to the customers. It's like an agent. It's like an agent. Bank as a custodian. Bank as act as a caretaker of something of the customer. That's why we call this custodian. While opening demat account, bank becomes a custodian. While demat account, stock market account, transferring amount, buying and sell the securities, the amount will be settled in the amount will be transacted through only demat account. That's why bankers as a custodian, bankers as a guarantor, bankers as a guarantor. This is called as banker and customer relationship. So remaining two topics is I'm left from the remaining. Tomorrow I will cover the remaining two topics in the first unit. And the remaining only 5 hours. There's 4 hours remaining. I'll complete within the 4 hours. Thank you so much, ma'am.
Yes, good afternoon, students. Yes, am I audible? Is my screen is visible to you? Yes. Good afternoon, students. Am I audible? Is my screen is visible to you? Yes, is my screen is visible to you?
Yes, sir. Visible.
Okay, okay, thank you. Okay. So, myself, Dr. Saravan, faculty from Department of Commerce, Pondicherry University, Karaikal campus. So, I'm going to handle a paper called Statistic Financial Management. Okay. So you have, I think you know, you have 6 hours actually. So in this 6 hours, we're supposed to complete your strategic financial management. But don't expect we have complete entire syllabus. We will highlight what are the important from the exam point of view as well as the syllabus completion point of view. Okay. So let me start with the introduction of the strategic financial management. So before going to the strategic financial management, we all studied about the during your first semester. I don't know whether it's a second semester. You studied about the financial management, right? So in the financial management, we studied about there are three basic function of or objective of the any business concept, right? So primarily, we suppose that is financial management was helping us to go for a profit maximization. Another one is wealth maximization, right? So this we understand in the financial management itself, right? So any business we are going to state, going to take it. So the business agenda, or maybe we call it as an aim or objectives, are supposed to fulfill profit maximization in a short run, wealth maximization in a long term or long run. Okay, so in that way only the business are established and they are doing that business. Okay, so how the profit and the wealth can be maximized? Okay, so we have a three tool. What are the tool we have? One is um, financing decision. We call it as an FD, and we have a investment decision, and we have a dividend decision. Okay, so these three decisions helping you to get a profit maximization. So if you want to maximize your profit, we need to take the three important decisions. The first one is financing decision, investment decision, and dividend decision. So in the financing decision, we discussed about various capital structure, cost of capital. Okay, same way with this investment decision. Now in a long run and short run, what are the things we supposed to consider when you're looking for an investment? If it is a long-term investment, we use the capital budgeting technique, right? So if it is a short-term investment, we call it as a working capital management. Okay, so these are the techniques are helping you to go for a better investment. Okay, so that is why we studied about the investment decision also. Same way we have a dividend decision. If you are invested in your money in a what they call in a form of equity share or debenture, what is the amount we are going to give? Whether retaining a dividend is better or paying a dividend to the shareholder is better. So in that way we are analyzed elaborately in the financial management. Okay, so it was the next version of the financial management. That is it's called as strategic financial management. So we are going to use certain strategy which is helping you to and all the three decision. So it is going to help your financing decision. It is going to help your investment decision. At the same time, it is going to help your dividend decision also. Clear up? So it was nothing but what we studied in the financial management. So financial management, we know what is our goal, how this goal can be accomplished. Okay, so with the help of the three decision, we can accomplish our goal. So that and all we studied in the financial management. Whereas in the strategic financial management, we are going to understand how each decisions are affecting to our in an overall objective of the business. How we are going to maximize your profit, how we are going to mm, maximize our wealth, okay, or we call it as optimization of wealth. So how this all can be possible? So we are going to discuss on in the strategic financial management. Is it clear? So with this, I was moving into the unit number. So we have a 5 unit actually. So these are the 5 units. So unit number 1, we are going to discuss on the general agenda. So what is mean by financial policy? Okay. So what are the strategic plans? What are the tools we have? What are the financial model which can be used to enhance our the business objective? Okay. Unit number 2, we are going to discuss on the investment decision alone. Okay. So how we are going to consider the risk and uncertainty. Well, okay. So certain time we are going to discuss on risk adjustment techniques. We are going to use some simulation technique. So this is all helping you to understand the investment decision, how the investment decision can take in a better way. So in that way, we're supposed to discuss on unit number 2. Unit number 3, we are going to discuss on the capital structure. Okay. So again, we call it as an artificial growth, because if you are going to start a company, we say, for example, in the year of 2024, in a traditional way, in an organic way, the company growth can be done only if it is more than 5 year or 10 year. But whereas nowadays we are able to get a what do you call it, due to the certain capital restructuring, or we call it as a merger and acquisition. So in that way, what will happen? A good company may acquire another good company, so that you may visualize the what do you call it, the return, or you may visualize the market share in a quite short period. Okay, because we are not moving in the traditional way. Because traditional way, the company will establish one particular area. They may get a good name after some year only, and it will take a quite long time to get a very good name in the public. At the same time, establishment will happen very long time. Nowadays, we are able to take an establishment in a short period due to the extension, or due to the capital restructuring. So how this capital restructuring is helping you to finalize, or helping you to profit maximization, that we are going to discuss in unit number 3. And unit number 4, certain techniques. Okay, it is not like a what do you call it? Say for example, I want to cultivate some rice or paddy or something, anything you can consider, even it can be any production also. Okay, sometimes purchasing a machinery will be too costly. Okay, so you may add a capital of some just 5 lakh rupee or 1 lakh rupee, but the material cost, or maybe the machinery cost will be 1 crore rupee. You may not be affordable in that time. So in that time, what you can do? You can get a leasing finance. These people will giving you the finance only for the using the machinery. Okay, so in that way, we are going to use how the leasing finance is helping you to finalize, or helping you to get a profit maximization. So the last one is, apart from that, we have some hybrid securities. So traditionally, we have 2 forms of securities. One is equity form, another is debt form. Apart from that, we have a statistically, we have a new forms of investment. So that will be called as an innovative source of the finance. So where the combined form, we call it as an hybrid securities, will be available. It is combination of equity share and debt. So how this is helping you to get a profit maximization. So it was nothing but, so what we studied in the financial management, we say that application of the financial management will discuss on the strategic financial management. Okay, how this thing is going to work. So we studied something theoretically in a financial management. How this is going to work in a financial management, we can discuss with the help of the strategic financial management. Okay, so with this, I'm moving to the unit number 1. You are able to follow me up. So far we discussed about what are the unit we are going to discuss. Okay, so can I go to the unit number 1 actually? You are able to follow me. So I'm taken your textbook. Okay, so the textbook which is available internet, that I am taken. So that I'm referring. You can, if you have your textbook also, you can keep the textbook along with me, so that you can have a connectivity. Is it clear? So can I proceed?
Yes, sir.
Yes. Okay, thank you. So unit number 1, we discussed about, it's just a general idea of the financial planning and the strategic planning. Okay. So unit number 1, we are going to discuss on, there are 4 content, that is financial policy and strategic financial planning. Second one is corporate planning, financial planning, and financial modeling. There are 4 content we are going to discuss in the unit number 1. Okay, I think we all know about the strategic, we all know, right? It is nothing but if you want to win a particular game, we need to form a certain strategy, right? Same way, if it is in a business, it's supposed to have certain clear cut role. So any business you are established, you supposed to have a purpose which is established, and what is the vision and mission, what is your objectives, what is your goal, it has to be mentioned in clearly. Assume that in the particular company, there are 1,000 employees are working. So all the 1,000 employees has to know the mission and the vision of what they call the business. So that only they can understand or they can contribute to the business mission. They can contribute to the business objectives or goal. So how this can be possible? Because if it will be clearly pre-written and it has to be communicated to the all the stakeholder in well in advance so that they will have a clear cut idea. Okay, so and these are the process of the strategic planning process. If you are planning anything, so you need to know what are the input you supposed to have. Okay, so input is nothing but you may have many content. Say for example, you need to get a market share by 30%. That is what your agenda by the year of 2030. Okay, so already you are having a some 15% of share, and this has to be increased 30% of market share in another 6-5 years. How this can be implemented? And for this, if you're all creating some input, that will be called as an input content. Same way, you need to understand about the industry profile, or we call it as an enterprise profile. So what the business is there, how much we have invested, how many days it is go. Okay. So in that way, if you are planning for enterprise profile, or we call it as an industry profile. Okay. And the third level is we are going to orientation the top manager, because the top manager has to know what has to be implemented. Because maybe in the middle level or lower level, you may get a mini labor turnover, because now people who are not in the organization quite long time, they will be in the organization only for 6 months or 1 year. So in that time, aligning with your goal with what do you call it, maybe the employee, it is very difficult. But that is why we are orienting the top manager, especially in the top level, maybe FM, maybe in a production manager, maybe in a finance manager. This has to be given oriented. Okay, so only those people got orientation. They have a clear cut idea. So what can be implemented, what should not be implemented, they have idea. Once the top management is there, and it can be followed to the low also. Okay, in the bottom also. Okay, so again, we need to know why this has to be given. Okay, the purpose and the objective has to be very clearly given. The purpose and the major objective of the endpoint towards the activities and the enterprise has to be directed well in advance. Okay, so how many days it is going to be there, whether it's going to be there for 6 months or 1 year. So how many days we are going to take to complete, or how many months we are going to take to complete that. Okay, so these are all very clearly has to be mentioned. And apart from that, we may have some external environmental, and we have a internal environmental. It is nothing but when you are forming an objectives, or when you are forming in a certain purposes, it may be affected by two people, two categories. One is externally, which is not controlled by you, and this are the factor which is influencing your strategic decision. Okay, especially like a political situation where you doing a business. Okay, maybe the demographical situation, maybe the geographical situation. Okay, if your business are in a already called maybe in Iceland or a Greenland or any other place, so in that climate you cannot cultivate something. In that type of place you cannot do certain activities. Okay, so this all will be called as an external environment. Even though if you are framing an objective, that may not be suitable for the particular climate, or that may not be suitable for the particular countries. Okay, particular social. Okay, so that are the certain factor which is against to you or maybe favor to you. This will be called as an external environment. Okay, so you cannot control anything on that. The next one is internal environmental. It is nothing but what are the factor which is going to affect from internally. Okay, so we call it as the strength and weakness of the individual business. Okay, so what are the strength? that business is possessing, or the weakness that business is possessing. So that you have to understand. It's like a SWOT analysis. So the first two strength and weakness will become from internally, and opportunity threats are from the external point of view. Okay, so and then if particular strategy is not working, so what are the alternative strategy you have? So that you have to form. Okay, so these are all will be like a theoretical and generical information only. Okay, and this all I'm skipping. So with this, we are moving on to the second, that is 1.12. Okay, so listen with me carefully. So unit number 1.2. So we are going to discuss on the corporate planning. Okay, so where we are going to discuss, we're going to discuss on what do you mean by corporate planning? So what are the different types of corporate plannings are available? What are the structural, what do you call the construction process of the corporate planning? So what is the difference between overcapitalization and undercapitalization? What are the effect of the capitalization, undercapitalization, and overcapitalization? That we are going to discuss here. Okay. So the concept of corporate planning is then recently gained what they call momentum. So maybe 30, 40 years before there was no corporate planning those days. Now it was started the recent concept actually. Okay. So it is nothing but how the business is going to be run. What are all the company's capital structure? So that will be called as an corporate planning. If you are going to start a company, and that company is going to be depend on only equity share or only debenture or its combination of something, whether it's a combo. So what is the proportionate of equity share and what is the proportionate debenture you are going to get it, and what is the rate you are going to pay, what is the interest rate you are going to pay for your debenture, and what is the equity rate you are going to pay, what is the dividend you are going to pay. So this and all will be called as corporate planning. This is nothing but you are planning for your capital. Okay, so if you are, this will be nothing but the planning for your capital. And with this, we are moving on to the what are the benefit of strategic planning. So these are explanatory. So there are the first benefits is financial benefit on the basis of empirical studies and the logical analysis. It may be claimed that impact of the strategic management is primarily is that improve the financial performance, because when you have a clear cut ideology, when you have a clear cut what has to be done and what should not be done, and so that you have a certain clearly visible plan, because you have a certain clear cut idea and that idea is helping you to save unnecessary cost. Okay, because you have an idea and that idea is telling that you should not do this and you have to do this, so that you can save unnecessary expenditure. In that way you may get a financial benefit also. So once you have a clear cut strategic, and that time you may get a financial benefit, you may get a what do you call it, enhanced capability for problem prevention, because you have a what do you call clear cut, or we called as a mind map, or we called as a route map. Okay, so or we called as a protocol, or we called as an SOP, that is standard operating procedure. With this, so we have clear cut ideology and it has to be implemented on the time by time. Okay, and you have a SOP for all of your activities. So standard operating procedure for your employee recruitment and for your maybe your production process, maybe the salary disbursement, where maybe the promotion or anything. If you are going to consider, you have a SOP. That SOP will helping you to prevent the problem before it occurs, because you are clear cut idea. Okay, so because if you have strategic planning well, and you may get a improved quality of the decision, because you have a discussing well in advance, so that you can get a proper decision on time by time. Okay, and Once you have a greater SOP, it is helping you to get a greater employee motivation, because once the employees are motivated, because they know what can be done and they know what should not be done. Okay. So in that way, they are able to get a proper motivation, because each and every time, if their employees are given what we call it, we say that if the employees performance is very good, you are pricing him. Okay. In maybe certain award, maybe certain what do you call it, something you are giving in a form of financial or non-financial form also. In that way, the employees are getting motivated. Okay. So because you have a certain protocol. Okay. And apart from that, you may have some negative effect of the strategic planning also. It is nothing but, since you are following a rules stringently, so what will happen? You may get a certain negative effect also, because people may think that it was people who are working very efficiently, only the system will be good. Maybe you need to form in a such a way that it has to be helping, it has to help the middle level management, it has to be help the all the average level employee also. Okay. So because once you are going in a clear cut rule, so in that time, there is a possibility for certain people may be left from that what they call the decision. It may create a negative impact also. Okay. So, and with that, we are moving on to the capitalization. Okay. So can I start the capitalization for now? So the first one unit will be theoretical nature. Unit number 2 and 3, we can have a certain problem also. So have you able to follow me with me? Yes. Can I start the capital structure for capitalization?
Yes, sir.
Okay, but listen. Yeah, thank you. So capital structure, we call it as a capitalization. It's nothing but we are going to take two things, that is the owner and the creditor. Owner is nothing but the equity shareholder. Creditor is nothing but people who contributed money as a debt. Okay. If you are going to start any business, you may have your own money or you may get a outsider money. Your own money will be called as an equity shares or original shares or the owner money. And outsider money will be known as the creditor money. Okay. And any business you are going to consider, it is going to be the combination of the both. Okay. You are going to get issuing a equity share sometime, it may be in a 60% or 70%. Maybe remaining percentage you may have a credit. It may be in the form of bank loan, it may be in the form of debenture, it may be in the form of bond also. Okay. So this will be called as a capitalization. So capitalization of a company, right? And let me put like this. So let me say that. Okay, we all know about our balance sheet, no? So the balance sheet will be look like this, right? In the we have a left side and right side, and the right side we have left side we have a liability side, and right hand side we have a asset side, right? In a liability side we have a equity shares if it is in a T format, and if it is in a we have a debenture. Okay. So equity share, let me put like I have some 20 lakh of equity share. Okay. 10 lakh of debenture. The total capital structure is 30 lakh. Okay. Or will be like a 30 lakh. We all know this, no? So the any companies that is ABC companies ABC Limited, and it has a capital of 20 lakh, debenture of 10 lakh, and the total is 30 lakh rupee. Okay. So this is called as a capital structure. Okay. So we are going to see whether this capital is appropriate, whether this capital is rightly weighted or not. So that will be called as over capitalization or under capitalization. Okay. So the capital which is the company is possessing, it may be exactly capitalized or over capitalized sometime. It may be under capitalized also sometime. So we are going to discuss one by one. Okay. So what I said, it was given here. The first one is over capitalization. So here they are explaining with this certain example. Listen here. A business said to be over capitalized when capitalization exceeds the real economic value of its assets. Is it clear? In that over capitalized. Okay. So what is given here? Capitalization exceeds the real economic value of its assets. Okay. Real economic value of assets. In that time, it will be called as an over capitalized side. Or otherwise, the second condition is a fair return is not realized on the capitalized. I'll give in some other way. Let me put like this. So, and you and your friend, both of you, rupee. Okay. So, A and B, both of them have a 1 lakh rupee. A received 1 lakh rupee at a 12% interest. Okay. So 12% means he will get a 12,000 rupee yearly. Same way, B invested same 1 lakh rupee in some other bank, whereas he got a 18% interest. Okay. So his income is 18,000 rupee. Okay. So we have two people here. One people is with 1 lakh rupee, he is receiving only 12,000 rupee. But B is the person receiving 18,000 for his 1 lakh rupee investment. Okay. So this will be called as an over capitalized, sorry, under capitalized. With 1 lakh rupee, A is able to get only 12,000 rupee. The reason is maybe he invested in some other forms of investment. That is why he is not able to earn 18,000 rupee. But whereas B is able to earn 18,000 rupee because he invested rightly. Okay. You are getting my point, what I am telling? So as per the B point of view, okay. So let me put like this: B can invest only 75,000 rupee to earn 12,000 rupee, but whereas A spent 1 lakh rupee to earn 12,000 rupee. Is it clear what I am telling? So one person with 1 lakh rupee is earning 12,000. Another person 1 lakh rupee is earning 18,000. So we are converting. A, sorry, B is able to get 75,000. We are equalating in that way. With 75,000 is earning 12,000 rupee, whereas A getting 1 lakh rupee just 12,000 rupees. So here B will be called as an exactly capitalized, whereas A will be known as the under over capitalized. It's nothing but more money is receiving a just less return. But whereas less return, he has a more income. This is called as under capitalization. You are able to follow me up? Sorry, over capitalization. More money is given and is getting a less return. You are able to more money, less return. I have given 1 lakh rupee, but earning 12,000 rupee. Another person with 50,000 rupees is earning at 12,000 rupees. Mean, and I paid more money to get a less return. These are the problems of the over capitalization. Are the causes of the over capitalization. The reason may be the different. Okay, so when you know in the balance sheet, you may mention that the machinery may be 5 lakh rupee, but the today worth of the machinery may be just 2 lakh rupees or 3 lakh rupee. So this may be the reason for you have over capitalized. Okay, so difference between your original value and book value of the machinery, and you have a huge potential of the promotional expenditure. We call it as an advertisement. Since you are and you are not able to get a proper sales. That may be the reason for overcapitalization, and it may be the third cause is due to the inflation also. Due to the inflation also, there is the possible for overcapitalization. You have a more money, 10 lakh rupee you invested, you got a 10,000 rupee. So this will be called as an overcapitalization. I have more money to earn a minimum amount. Okay, and sometimes it is called as a shortage of capital also. Okay. So these are all self-explanatory by remaining at a depreciation and taxation policy, dividend policy and all. Yeah. the causes for overcapitalization. Same way we are going to discuss on undercapitalization. Okay. Yes. Can I go to the second item for now? Undercapitalization. So in the undercapitalization is the reverse of the overcapitalization. It should not be confused with the condition implying the lack of fund. It was not, don't put it in that way. This is not a lack of fund. It is merely refer that amount of outstanding stock. It does not pose an economical problem. Okay. And the capital structure. The condition is not on a serious of that overcapitalization as in the undercapitalization. Okay. So almost here is same type of example is given. I'll give some other example so that you will understand it better way. Okay. Overcapitalization, sorry, undercapitalization is nothing but same there are 2% part. A and B. Okay. A 50 lakh rupee invested. B also invested 50 lakh rupee. Okay. So as per the A point of view, A what happened? E able to receive at a 10%. 10% of 50 lakh is how much? Almost 50,000 rupee. 50,000 rupee is receiving. Sorry, 10% mean you can cut 10. That is 5 lakh rupee. 50 lakh, 10% is 5 lakh rupee. Okay, at 10% is 5 lakh rupee. Same way, B invested 50 lakh rupee at 12% is receiving 6 lakh rupee. Okay. As per the B point of view time, what happened, pa? And B have a potential to get a 12% interest, right? So 50 lakhs, 6 lakhs is getting. If it is in a 1 crore rupee, you may get a almost 12 lakh rupee. Clear? So as per the B point of view, he is able to get a more return. What about A point of view? Okay. A 50 lakh rupee is earning just at 5 lakh rupee. Yearly is earning just a 5 lakh rupee. But it has a potential also. Or otherwise, we can say that 10 lakh or we can say that 12% is the interest received from the A, B investment. And whereas A is able to receive a 10% of investment. And the difference is we called as a 2%. No? So that 2% will be called as an undercapitalization. Okay. Clear? So the undercapitalization is nothing but there is a person who is potential to grow further, but what happened due to the certain other factor, maybe it may be any other factor. Okay. So since this business cannot be increased, okay, the capacity of the business is optimum. The capacity of business is reached maximum. Okay, let me put like this. I have one hotel. In the hotel, assume that there are only 5 rows of chairs are there. In a particular time, even it is a peak time, I can accommodate just 50 customer. Okay, 50 customer only I can accommodate. So even though I have a good number of promotion also, but I cannot increase my customer because I can have a capacity to serve only 50 customer. Clear? It will be called as an undercapitalization. Clear up? So I have, even though I was doing more promotional expenditure and other things and all, my revenue cannot be increased because my revenues are fixed. I can be able to serve only 50 customer. If only 40 customer is coming, it is no okay. 50 customers are coming, that is only is my maximum capacity. I cannot increase to 60 customer or 70 customer. So if my capacity is limited, why should I pay more money to get a same income? Clear up? This will be called as an undercapitalization. So what is required, that has to be kept in our business. So why should I pay extra money to get a less return? That will be called as an undercapitalization. You are getting my point what I'm telling? So the capitalization we are discussing here, it will be in two forms. One is overcapitalization, another one is undercapitalization. So overcapitalization, what is required? I was having a more money to get a less return. Okay, in the undercapitalization, it is the reverse case. Okay, with the less money, you can get an optimum return, because here you cannot increase your capacity. The capacity is fixed, then why should you going to pay more money, going to get a 10% return? Okay, so in that way we have a undercapitalization also. So these are the problem, these are the causes is given. So this are all you can understand when you understand that, but that is overcapitalization and undercapitalization. Clear up? So with this, can I go to the over trading? Yes.
Yes,
Is it
sir.
clear up? Can we go to the over trading now? So we discussed the so far two items. Initially, we discussed about the what is the strategic planning, and we moved on to the corporate planning. In that, we discussed about capital structure. In the capital structure, we discussed about maybe in the two form. One is over capitalization, another one is under capitalization. So with this, I'm going to discuss on over trading. So over trading is the term, means that expansion of a production and say financial support will called as an over trading. If a company find itself an easy market, okay, it may be increase the production and sales may be meet to ready-made. Okay, so what happened? It is nothing but without any proper or without any financial support, with the easy market, if the companies are able to sell extra commodity, this called as an over trading. You have a capacity to produce only 1,000 units. But what happened? Due to this or some other factor, or due to the what you call the readily available demand, and you are able to meet 1,500 customer also. In that time, it will be called as over trading. You have a potential to trade for only 1,000 customer, but you are dealing with 1,500 customer. In that time, it is called as over trading. So what is required and what is your potential? You are beating that potential for this called as over trading. And this all is given. What are the causes of over trading and what are the problems you may be faced? So that all is given. Same way we have under trading also. It is nothing but the reverse of the over trading. Okay. So with this, I was moving to the third item, but that is financial planning. Okay, ba? The financial planning is nothing but you can compare anything. But say, for example, I'm planning to travel in an international trip. Okay. So whenever you are planning for an international trip, we need to plan for the finance, right? So I need to, what are the, I'm supposed to list out what are the uh, potential expenditure can break up. No, one is the primary, whenever you're looking for an international trip, you need to plan for the airport, right? So the airfare. So two-way airfare. Say, for example, I'm planning to visit. So from Chennai to maybe I'm planning for an Abu Dhabi or maybe in a Dubai. So what is the fare is going to be there? Let me take that. I myself and my wife, we are want to travel to the Dubai. So I need to plan for the finance, no? So first of all, I need to know what is the airfare to Chennai to Dubai. Two-way for the both the people. Okay. And then I need to plan for the hotel. If I'm planning for 7 days, and I need to know that what is the hotel which is available And I have some list outs, no, that one is a transfer, another one is hotel, another one is consumable, another one is will be called what we call maybe we call it a contingency. So these are the heading I'm preparing, but travel alone, it will be go to 1 lakh rupee. Maybe hotel will go to another 1 lakh rupee for 7 days. Maybe the food will be taken another 50,000 rupee. Like this, I have some budget actually. Okay. And then that budget I was preparing for. It may be some 5%, 10% error may happen. You thought to conclude by 1 lakh rupee, but it may go to even 1.2 lakhs also. But that is the secondary case. But you need to arrive the what are the expenses going to happen when you are going to travel. Okay. So you are writing and you prepare the budget, and based on that budget, you are looking for right. Same way, if it is a business, they need to plan for the finance. Okay. That is what given here, the financial planning. Okay. In the financial planning, if you arrived, say for example, for the two people for 7 days to visit Chennai to Abu Dhabi, it was required some 3 lakh rupees. So that we came to a conclusion. And if that 3 lakh is you are arrived, how you are going to raise that 3 lakh rupees? Whether you are going to meet on your own salary, whether you are going to borrow money, okay, whether you are going to take from your grandparent, or whether you are going to take your friends, or whether you are going to get a loan. So these all will be taken to the consideration once you arrived upon. Same way, the amount of capital to be raised has to be clearly given. Okay, so we need to know how much we are going to raise the capital to establish a business. And the forms of proportionate amount of security to be raised. It is nothing but assume that the cost of the travel is 3 lakh rupee. How much you are going to take on your own money, how much you are going to borrow. So in that proportionate you are going to arrive. Okay. And once that is over, we are going to administrate the capital. It is nothing but I know how much I need to raise. I know how much proportion I'm going to give. Maybe 30% is debt and remaining 70% own money. In that way, if you are arriving, and now we are going to arrange that money. So once you arrived at that, you can go to the what do you call it? The administration of the finance. Okay. So it is nothing but whether we are going by the same way. So I know what is the air travel, I know what is the hotel travel, the hotel fees and all. And I need to administrate. There's nothing but whether my original flight ticket was as per the budget one, whether my hotel stay and all as per the budget one. In that way, I'm going to work out. This will be called as a financial planning. Okay. So these are some self-explanatory only. So the steps in helping for the financial planning, how we can prepare for the financial planning, what are the establishment, how you can form a policy, how you can forecast actually. Okay. So formalization of the procedure, so these all will be called as a blueprint. Okay. For the financial planning. Okay. These are all self-explanatory. So I'm skipping this. So with this, we are moving on to the financial modeling part. It is nothing but we are going to use a certain predefined model for your finance. That's all. It is nothing but like a simulation technique. Say, for example, if you want to perform a what do you call it, a dance in a particular crowd, okay? So you have some rehearsal, no, right? So if you want to sing, if you want to go into write an examination, you are writing. You are vertical, you are preparing the examination and you have some rehearsal, no? Same way, the financial model is nothing but rehearsal with some dummy data sometimes, or maybe some original data. It's nothing but a simulation technique. Okay, the simulation technique is helping you to give a real-time solution. Okay, so this is known as the financial. Okay, what do you mean financial modeling? It is going to yield a real-time solution for particular problem. This is called as a financial modeling. Okay, the financial modeling is nothing but it have many financial modeling. We have a Monte Carlo simulation technique. We have a histogram simulation technique. There are various techniques are available for the particular situation. If you are going to working for the working capital, how much you can get a working capital? Okay, so this all we have some various techniques. Some problems are there. This will be called as a financial modeling. Okay, so these are the different types of financial model. For the risk analysis, we used for analyze the different type of risk. Risk analysis, we have certain tools. Maybe trading model, we have a portfolio management, sales trading functional. So like this, for the different functional aspect, we have a different tools. Okay. And these are the tools and techniques of financial modeling is given. We have a, what do you call that? Sensitive analysis. Sometimes we need to analyze the sensitivity of the, maybe if it is in a shares or a debenture, we need to analyze the sensitive portion. Sometimes we can look by the scenario portion. It is nothing recreate the situation. Maybe you may have be witness. Maybe the government of police department or police department, they may have, maybe military, they have what they call the rehearsal of something, right? Same way the fire department have how we can supposed to react during our emergency situation. Okay, so yeah, we all come across, no, this will be called as a scenario analysis. So what what can be happen in a particular time and overcome. Okay, and apart from that, we have a Monte Carlo simulation. It is nothing but we are going to use the random data. We call it as a normal data. How the normal is going to work out. In that way, we can work out the Monte Carlo analysis. This all is nothing but it is going to help you in a particular situation. If it is a stock market production, we have certain analysis. If it is in a cash budget, we have some analysis, risk analysis. If it is maybe in a cash budget preparation, we have some analysis. These are the analysis helping you to give you the solution for real-time problem. Okay, so this all is known as the financial modeling. So we are modeling some financial help. Okay. Okay. So up to this, you're able to follow me up. So we discussed about the 4 concept in the unit number 1. Okay, so let me recollect. So with this, I conclude today classes. Tomorrow again, I have a 12 o'clock class. In that time, I will inform. I will start with unit number 2. Okay, so unit number 1, we discussed about financial policies and strategic financial planning. Okay, so and then we moved on to the corporate planning. So in the corporate planning, we discussed about what do we mean by capitals. And we have a 2 type of capital, like over capital and under capitalization. And same way we discussed about over trading and under trading. And we moved on to financial planning also. In the financial planning, we discussed about what are the monies required, and we are going to list out what are the excesses going to be happen in a particular situation. So this is how we discussed the financial planning. The last one we discussed about financial modeling. Okay, in the financial modeling, how the various model like Monte Carlo simulation, maybe risk analysis, maybe in a scenario analysis. So these are the analysis helping you to give a particular time by time situation. If it is a cash budget, we have some situation. If it is a risk analysis, we have certain situation. In that way, we discussed. Okay. So with this, I can say the unit number 1 is we covered. We cannot say entirely completed. We covered certain things in unit number 1. Okay. So in next class, I'm going to discuss on the investment decision. I'll try to conclude in the 5 class. Maybe in my last class, I'll discuss with the question paper. Okay. So I'm planning in that way. By each class, I'm supposed to complete at least 1 unit, so that only we can complete a 5 unit in the 5 hour. And the 6th hour, we can discuss the old question paper also. I'm helping you to discuss how we can give a solution for the old question paper. Clear up? So next class, I can discuss on the investment decision under risk and uncertainty. Same way the statistical distribution approaches also. Okay. So in the unit number 2, we have some problems that we can discuss in the next class. If you have any doubt, let me know. Otherwise, we can conclude the today class. Yes. Okay, pa. Okay, thank you. Thank you, students.